downside scenario for almost every asset class. Live from Studio 2 at Bloomberg headquarters here in New York, I'm Romaine Bostick.
And I'm Katie Greifeld. Kicking you off to closing bell here in the U.S. It's not too pretty of a picture. Again, with about 2 hours ago, the S&P 500 off by about 0.6%. It's the same thing if you look at big tech. The NASDAQ 100 off by about 0.6% as well, building on yesterday's losses. And once again, you have a sell-off in the Treasury market. You take a look at benchmark 10-year yields right now, higher by 8 basis points. We're looking at 462 almost on the 10-year yield. That is the highest level going back to 2007. And all the while, oil as well on a tear. You can see crude oil. We got above $94 a barrel earlier today, currently about 3.5% higher, Romaine.
Yeah, and if you remember, Katie, it was at the start of last week where we hit 91 bucks a barrel on WTI. At the time, that was a year-to-date high, but that march towards $100 a barrel actually was put on pause for quite a few days, but now resuming here on this Wednesday afternoon. We talk about the idea here, the March higher, and the biggest one-day surge right now that we've been seeing in futures prices going back to mid-June. Now, that's taken out both the year-to-date high, and it's also taken out, believe it or not, that 52-week high as well here. We talk about why, and we talk about what's next here. A big investor positioning right now, whether you're looking at the CFTC data here on the U.S. side or overseas there when it comes to Brent crude, the trend right now appears to be going higher, and a lot of that has to do with the premium that we're seeing between the front month contracts and the end month contracts here. And the narrowing in that space here seems to suggest right now that we're talking about the potential for an increase in the tightness in supply. That tightness, of course, a big part of the reason why we've been continuing to see that march higher. A huge turnaround for oil here, which at the end of June was sitting on a 12% price decline, but has since rallied more than 30% since. A similar pattern unfolding for the dollar, which was in the red for the first 6 months of the year. That has since crawled its way higher by about 5% from the year-to-date lows back in July. That Bloomberg Dollar Spot Index currently on a 6-day run, longest daily win streak of the year. But SocGen chief FX strategist Kit Juke saying that he sees the potential for a reversal if a U.S. government shutdown lasts for more than a week or two. A scenario, he says, will, quote, derail the doom loop of rising yields, rising dollar, and a, quote, still okay economic data. But for now, yields aren't cooperating with that scenario. The benchmark 10-year higher for the 8th time in the past 10 sessions, and compensation that investors demand to hold those longer-dated issues, that so-called term premium, Katie Greifeld, has this month widened to some at the fastest pace that we've seen since 2009 at the end of the financial crisis.
And we can say we're back in positive territory, at least if you look at the New York Fed's model of the 10-year term premium. Like Romaine said, this is the extra compensation that investors get over holding the expected short-term path of rates. You can see that we flipped back in 2021. This is the first time we're turning positive. But really, for the past 7 years, the term premium has been deeply negative. So we'll see if this is sustainable. And the fact that, again, the first time since 2021, pretty dramatic, but then you take a look at nominal interest rates, even more dramatic. The sell-off across the curve, bringing us to cycle highs, especially when it comes to the long end of the Treasury curve. You're looking at 10-year yields, you're taking a look at 30-year yields. We are at the highest levels going back to 2007, 2008 territory. And the question becomes, Romaine, where's the ceiling? Where do we stop? And also, what is actually driving this? All
right, well, let's pose that question to our first guest. Maureen O'Connor joining us right now to kick us off to the close. Global head of high-grade debt syndicate over at Wells Fargo. Maureen, great to have you here. And let's actually, I'll just steal Katie's question there because I think that's what everybody really wants to know. When do we sort of start to finally see that top?
Well, I think our call at Wells Fargo is that we're pretty much looking at it right now. I think, what we're dealing with is at first sort of a simple supply and demand imbalance, right? You have the Treasury that's been ratcheting up supply. We had the refunding announcement in the summer that obviously surprised to the upside. You couple that with a more hawkish Fed sentiment from last week, threw a little bit of gasoline on the fire. And then on top of that, you have balance sheet liquidity that's pretty constrained right now. You have the Fed draining liquidity out of the market. You have balance sheet liquidity across the street from a regulatory standpoint only getting lower. And then you pair that against an environment environment where foreign demand for U.S. Treasuries is, definitely ratcheting lower as the cost to hedge dollars against other G7 currencies has gotten prohibitively expensive. So you're really talking about technicals here that are pushing things higher. I think the concern is, do we hit a point at which you start to see some of that convexity selling from the mortgage portfolios?
Yeah.
And I'm not sure that we're there yet, but we're flirting with it.
Well, then fold that into the corporate credit space as well, because, you can look at what we've seen in Treasury yields, and I think there is certainly some negatives there that people will look at. At the same time, when that feeds into what I guess maybe you're seeing right now in the credit space, particularly with investment grade credit, I would think that would also present some degree of opportunity.
Yeah, well, I mean, it's interesting. When you look at the investment grade bond market right now, yields are basically at the year-to-date highs. But the percent of yields that is represented by spreads, so the spread over which, our bonds trade relative to the benchmark, is at its lowest since 2007. So said another way, 80% of the yield in our market is Treasury yield. So it's almost like investment grade and credit more broadly is trading a little bit like a macro product, trading like a rates product. So when you think about 6% yields at investment grade, which is kind of where we're sitting right now, that historically has been a very, very strong entry point for investors. So we have a lot of demand for our product right now. Unfortunately, for borrowers, it's a much more difficult landscape to navigate because you are looking at probably some of your most expensive debt in a cycle. And the question is, can you weather this storm long enough? How much is higher for longer? How long are we going to be in this environment? And what can you do tactically to access the market in a way that feels as painless as possible against a higher rate environment like we're in?
Well, that's where I wanted to go. If you're a borrower right now, you're looking to issue debt. Are you on the sidelines? Are you trying to time this market?
So the answer to that question is it depends on who the borrower is. And actually what's been interesting about the supply that we've seen this last month, it has shifted in favor of our spread-based borrowers. So issuers that tend to swap their fixed coupons to floating, a lot of bank supply. Spreads are at year-to-date tight. So naturally, if you are a spread-focused funder, this looks like an opportune window to come. If you are a corporate borrower and tend to be more fixed-rate focused, now you have to shift your thinking towards more defensive strategies like you're referencing. Some options are to use some of your balance sheet liquidity and pay off your near-term maturities with cash and de-lever or fund whatever you need to do with your cash on hand. So you are seeing a little bit of that, but you're also seeing a shift shorter on the curve. So a lot of borrowers have decided that even though the curve is inverted and even though short-dated issuance is expensive, at least I'm locking in these coupons for a shorter period of time and giving myself the opportunity in perhaps a couple of years to take those coupons out at what would hopefully be lower rates in the future. And so you're seeing quite a bit of that.
So as you're seeing some of that shift and maybe borrowers being a little bit more selective here, has that translated into sort of a technical tailwind in that there's less supply on the market but a lot of demand?
Absolutely, and most pronounced in the long end of the curve, right? So we talk about the shorter duration of issuance. Just to put that into context, long duration supply, that 16-year plus bucket in our market, is down 15% from last year. It's down 40% from 2021. It's down over 60% from 2020. And when you think about who's buying credit at these elevated yields, it's a lot of liability-driven investors. It's insurance companies and it's pension funds, and these are the folks that need duration. So that supply-demand imbalance is so pronounced in the long end of the curve, it makes a very strong argument for flatter spread curves going forward, and that's indeed what's played out this year.
When we looked at that sort of spate of new issuance coming into this month, as most people expected, partly because of seasonality and partly because, well, most people thought the Fed would be out of the way. Do you think that resumes once we get a little bit more clarity out of the Fed, or is this kind of it? Did we just see the big bulk of issuance come now for the rest of the year?
There's going to be spurts. So, Romaine, as you point out, some of this is just seasonal. We come back with that kind of back-to-school effect right after the Labor Day holiday, and issuers get ready to fund, and they did. And now we'll head into a seasonally quiet time in October around third quarter results, and the window will open back up again in late October, early November. If rates move lower from here, I think you probably will see a little bit of pull forward from our next year calendar. But if they don't, what you're going to be left with is more bank supply and some M&A volumes. By virtue of M&A, you just don't have the flexibility to pick your windows as as flexibly as some of our other borrowers can. So I think we will have supply in the fourth quarter. I think it will probably run below the average.
All right, Maureen, always great to talk to you. Maureen O'Connor there, Global Head of High-Grade Debt Syndicate over at Wells Fargo. Kicking us off to the close here. Before we move on, we do need to bring you some breaking news. This on the United Auto Workers strike here in the U.S. We're now learning that the head of the union, Shawn Fain, plans to announce an expansion of that strike as soon as Friday. He has scheduled another live stream on the web at 10 a.m. Eastern time and says that they will expand the strikes on Friday, barring any major progress at the table. We'll continue to follow that story here on Bloomberg and bring you any updates as soon as we get them. In the meantime, we're going to have a sit down in just a second with Sonia Meskin, head of U.S. macro over at BNY Mellon Investment Management, her take on economic conditions.
And we'll go global and focus on the opportunities for private equity investments in Africa with Runa. She is co-founding partner and CEO at Development Partners International.
And earnings season, Katie Greifeld, it never ends. We get another one after the bell tonight. Micron reporting, investors watching closely for any signs of a rebound in sales of memory chips. The numbers and the breakdown as soon as we get them, a preview before we get them. All that and more coming up in just a bit. This is Bloomberg. All right, the latest read on the U.S. economy out today, coming in strong. Orders placed with factories for business equipment rebounded in August, suggesting that business investment is actually holding up against higher borrowing costs. Unfortunately, as we were just talking about with our previous guests, those borrowing costs could continue to creep higher as Treasury rates continue to move in the same direction. Sonia Meskin, head of U.S. macro over at BNY Mellon Investment Management, joining us right now. Sonia, great to see you once again here. Let's start here before we get to some of the economic conditions. I do want to start off with rates here. I mean, just as we're speaking here, we're seeing once again, fresh highs for some of the key parts of the yield curve, including 10 basis points higher on a 5-year. When you look at the trajectory of rates going higher, this latest batch of increases here, what is that actually telling you? I mean, what do you think people are trying to price into this market?
Well, it's a tough question because there could be longer-term issues at play, such as the fiscal trajectory of the U.S. economy, and generally potentially higher rates for longer that central banks, including the Federal Reserve, have been really talking about. But it could also be the supply and demand story, right? Because we are, since the refunding announcement this summer, rates have been moving higher, and of course, other central banks, the BOJ in particular, have also changed policy, and so this leaves us with fewer buyers in the market potentially.
I am curious, though. You and your team over at BNY Mellon, you put out your outlook for Q4 as we sort of end Q3 here. And a couple things jumped out at me, and that was the talk about recession and the talk about almost the inevitability of it in the short term.
Well, we do assign a somewhat higher probability to the risk of, the fat tail, so to speak, right? I think markets have gotten quite optimistic about the soft landing, especially in the U.S. But what could potentially happen is with the economic strength we're seeing here, inflation could prove sticky in the services, especially. As we've discussed here, and Neil Kashkari just put out an essay on this as well. And so if that happens, the Fed may feel the need to slam on the brakes and engineer a recession, in fact.
And so what is the recessionary playbook, though? Because, okay, the U.S. hits a recession, you buy bonds, but you take a look at the bond market right now, it doesn't seem like that's a safe place to hide out. If we do get that economic downturn, where's the safety?
Well, we do actually think that higher quality fixed income should fare better in that environment than low graded fixed income, or unfortunately, some of the riskier stocks as well, right? Companies that have issued a lot of debt, lower rated debt, I think they're a little bit more vulnerable in that environment. It's important to mention, too, that we do see still a higher probability of a soft landing in the U.S. in particular than, unfortunately, in Europe, where the terms of trade shock from the energy, for example, right, energy prices are still higher today, is being felt more acutely.
And you talk about Europe, but talk to us specifically about UK, because I'm looking through your notes and you say the UK in particular really stands out here in a bad way.
Yeah, it's an unfortunate situation because they're facing the difficulty that is similar to continental Europe in the sense that the high energy prices are really hurting them. But in addition to that, they have the issue that is even more pronounced in the US than in continental Europe, and that is the shortage of labor supply. So stagflationary risks are higher in the UK than in continental Europe or in the US for sure.
Is there a synchronization here in terms of the economic story, or are these going to be sort of individual stories based on the region?
Yeah, they may be to some extent.
Yeah.
I do think we're going to see more of a divergence in 2024 than we have, immediately after COVID.
Is there anything though that, I mean, like what saves us? I mean, okay, so even if you have sort of a worst case scenario for a recession coming, I mean, Katie's been looking at, the Taylor Swift bump in Kansas City, and there are other factors, but in all seriousness, is there anything out there that you see as a potential net positive that maybe helps us get to that soft landing and avoid recession?
We've been saying this a lot, and we still believe it, that balance sheets are still quite strong in the U.S. The consumer has been very resilient, and we are hoping for the consumer to remain resilient, even though we do see pockets of weakness, popping up. Overall, as long as the labor market is strong, the consumer should remain relatively strong.
And so far, that's definitely been the trend. Sonia, it's great to see you. Sonia Meskin.
I bought something today.
Did you?
Yeah.
No kidding. Taylor Swift tickets, maybe, for the Era store. In any case,
I can't afford that. You know how much those things cost?
Roughly $1 million last I checked. Sonia Meskin, she is head of U.S. macro over at BNY Mellon Investment Management. Now, coming up on The Close, we'll speak with Runa Alam. She is co-founding partner and CEO at Development Partners International, about why she says Africa represents a unique opportunity for investors. That conversation coming up next. This is Bloomberg.
All right, we started the show off talking about the U.S. markets with Maureen O'Connor and then pivoted to what's going on over in the Euro and UK regions here. And now let's turn to emerging markets, specifically Africa, and some of the challenges there, challenges that for some are leading to a de-risking and for others leading to the search for opportunity and new investments. Runa Alam is co-founding partner and CEO over at Development Partners International. It's a private equity firm that focuses on investments in Africa. And Runa, we wanted you back here because you really have your finger on the pulse, I think, of what's going on there. And we were speaking with someone maybe about 2 or 3 weeks ago that was talking about this idea sort of where the opportunities are in a high rate environment, and more importantly, in an environment where a lot of people are trying to de-risk here. Is there anything that you're seeing out there right now that I guess keeps you encouraged in the face of whatever short-term cycle we're in right now?
Absolutely. So some of the secular trends in Africa are very compelling. By 2050, 1 out of every 4 humans in the world will be African. Some say even 1 out of 3. Around the same time, 10 of the largest cities in the world will be in Africa, 10 of the 20 largest cities. When you look at those trends of urbanization, population growth, a young population, average age only 19.5, that means there is a growing consumer class in Africa and a growing mass market. That creates opportunities for companies that actually develop and sell those products, be they goods and services. In Africa, we're still seeing through our companies the mismatch of supply versus demand. So even in a down market, high inflation, devaluations, that opportunity still exists. And we know that through the growth of our companies in Africa, even today.
One of the reasons why I asked that question is the conversation I was having a couple of weeks ago came up in the context of kind of all the attention that's being put on India right now. The idea that, at least as far as a major emerging market economy, this seems to be kind of the shiny object out there. But then we were talking about the amount of investment that African nations are looking for when it comes to infrastructure, when it comes to technology and other things, billions and billions of dollars. But a lot of that money, instead of flowing into those nations, seems to be chasing after India here. Is there sort of, I guess, a common ground, if you will, or some sort of sharing of resources that you think investors might actually see?
Well, I think one of the answers to that is lack of competition. If investors are going to a certain region of the world and another region of the world has 5 out of the top fastest growing countries, and at the same time a small amount compared to other regions of the world of private capital, that creates opportunities. And that is the space and that we've been in, and that's the reason we are in Africa. So absolutely. I should mention also one of the great opportunities, something you mentioned, which is technology digitization. While digitization has grown everywhere during COVID, in Africa, because of the lack of legacy assets, it's made a huge impact, again, on the delivery of goods and services to the mass market rather than just the middle class, and all sorts of goods and services. Again, another great opportunity around which one can coalesce investing in companies that provide those opportunities.
Well, when you think about those opportunities and those emerging themes, such as around digitization, and then you think about the macroeconomic context of very high inflation and very high and rising interest rates around the globe, particularly in emerging or rather in developed companies, how high of a hurdle is that for some of these potential investments that could be heading to Africa?
Well, in Africa also, parts of Africa, and let's remember it's 54 countries, there is inflation in parts, and there are very well-balanced economies in parts, and therein lies the opportunity. Yes, in parts of Africa, you have inflation topping 30%, and then in other parts of Africa, namely Francophone West Africa, where you have a very calm currency pegged mostly to the euro, so it's been devaluing calmly over the last several years. You have 6% growth, one of the fastest growing regions in the world, and that's the region that has a lot of opportunities. And again, a developing region where we have companies like Cofina, which is a multi-country credit company, and then Solevo, which delivers goods and services in the agribusiness and chemicals area, hugely fast growing.
I am curious, though. I mean, over the last few months here, there has been renewed concerns about political instability, whether you talk about the coups in Niger or Gabon or some of the other places here. And there has been some speculation that this might be part of a broader, maybe even cyclical trend here, where some of the old regimes are now facing, I guess, the consequences of economic decisions that could create further instability.
Yes, and this is really something that we are definitely looking at. And the interesting thing I've learned from our companies and from my colleagues in the last few weeks is the following. Yes, there have been 3 coups in Francophone West Africa, but again, the largest economies in the region where most of our investments come from, Cote d'Ivoire and Senegal, are stable. However, even in countries like Niger, there has been a coup, but the government has left the private sector operate as it had operated before. So our companies in Niger are actually doing fine. So one has to separate, especially in a place like Africa, the political from the economic.
All right, Runa, I'm going to have to leave it there. Really appreciate you taking time for us and staying up late there over in London. Runa Alam there. She's a co-founding partner and CEO at Development Partners International here. And we should point out that Katie Greifeld, I mean, emerging markets, remember we started this year and everyone said EM as a group was supposed to be sort of kind of in this new renaissance, and that trade kind of faded largely because of the yield story. And we know, of course, EM isn't a monolith. I mean, as she pointed out, I mean, we're talking about dozens and dozens of nations.
Yeah, 54 countries in Africa alone. It's a great reminder, even though when we talk about EM, we're often talking about China.
All right, and we're going to talk a lot more about what's going on in the markets back here in the U.S. Stick with us. This is Bloomberg. This is the countdown to the close. Equity markets remain on the back foot for yet another day. Meanwhile, yields continue to tick higher, and the dollar right now on its longest win streak that it's seen all year long. That's having an outsized effect on the commodity space. Let's go to Abigail Doolittle right now for our commodities close. Abigail.
It certainly is, that strong dollar having an effect on the commodity space, Romaine. But what's so interesting, the Bloomberg Commodity Index overall is actually higher despite that dollar strength. Typically, it would drive commodities lower. But you can see we have some real strength here for crude oil, one of the big components to the Bloomberg Commodity Index. And this has to do with the fact that crude stocks fell 2.17 million barrels for last week. Gas also going along for the ride, up 4.3%. And on crude oil, the spread between WTI and Brent crude narrowing, which in this current environment is a long way of saying crude oil is going higher. back above $90 per barrel clearly right now. To the downside, though, and this is one piece of weakness within the commodity space today, metals having everything to do with that strong dollar. The last time I looked, I think the Bloomberg dollar index was up about 0.4%. These precious metals, silver does have some industrial uses, but really it will go opposite of the direction of the dollar. Now, finally, on the month, because we are ending month and quarter end, this is pretty interesting. We're looking at the worst month for the S&P 500 going back to December of last year or September of last year, depending. Right now, it's down about 6%. This chart's showing less. It's not exactly precise, but you can see the Bloomberg Commodity Index is basically flat. So we have an interesting divergence here between these two silos of risk assets, Romaine.
Yeah, interesting to see some of those moves in risk assets, or moves that, of course, could actually be upended if we do head towards a U.S. government shutdown. That is the potential that looms for this weekend. And one sector that could get hit the hardest, federal contractors, the Lockheed Martins, RTXs, and General Dynamics of the world, among some of the companies facing the biggest risk. Joining us right now is our very own Eric Wasson down on Capitol Hill, who's been keeping an eye on this. And Eric, we should point out to our viewers, we just heard from the Senate leader, Mitch McConnell, talking about the prospects for a deal, and at least in his language right now, says the House and Senate are still far apart. Give us a sense here now as to who actually gets affected. I'm talking about the companies and contractors that get affected, the economic impact if we do get to that September 30th date and there is no deal.
Well, we looked at the general economic impact of a shutdown. Bloomberg Economics estimates that a 20 basis points drop to GDP for each week that the government is shut down. But it's really concentrated both among federal employees. There's 2 million federal employees and 1.3 million active duty military who will not get paid, although many of them will be working during the shutdown. And then there's the federal contractors. And our research at Bloomberg Government indicates 1.9 billion in revenue per day delay or loss to those federal contractors. That's everyone from SpaceX to your janitorial services to your lawn care at the military bases. This is going to be widespread. And the longer that the government shutdown goes on, the more that those effects ripple out into the economy.
Yeah, widespread impact, a good reminder too. And of course, the length here matters as well. So too does the economic backdrop. If you think about where we are now versus the last time the government shut down a few years ago, obviously we're dealing with higher inflation and much higher interest rates. What could that mean for the type of revenue that could be lost here?
It's a really good point. A lot of contractors, especially small contractors, are going to have a real cash crunch. If you look at multiple weeks, even to a more than a month shutdown, that revenue not coming in, they're already facing a cash flow issue because of inflation and because of the workforce issues that they've faced. And when you go into the capital markets with the higher interest rates, it's hard to raise that money without, we could see companies go belly up. I talked to Eric Fanning at the Aerospace Industries Association. He made that point. A lot of these federal contractors are bracing for this and writing Congress furiously saying, do not let the shutdown happen, find some way to avoid it.
Another issue that's come up, Eric, is really kind of the high interest rates that we have out there. During the last few shutdowns, particularly for those businesses that were dependent on government contracts and some degree of government financing here, they had to sort of, go to the private market where they were getting higher rates. But of course, that was at a time when rates were near zero.
That's right. And, during the last government shutdown, 35 days to remind their viewers in 2019 when President Trump wanted this border wall, that was actually a partial government shutdown. The Department of Defense was open, the Labor Department was open, but others, like the Homeland Security Department, were closed. Interestingly, another big aspect to this economic story is the economic data that won't be available. The Bureau of Labor Statistics, the Commerce Department, they all won't be providing economic data. That's going to make it hard for the Federal Reserve in their November meeting to make an interest rate decision. So there's going to be ripple effects if they can't find a way to do a deal. And right now, it looks like a government shutdown is almost a certainty. I do not see how one on Saturday night at midnight can be avoided.
Well, Eric, I'm sure you're going to have a very busy weekend. Appreciate your time right now. That is Bloomberg's Eric Wasson joining us from Capitol Hill. And it's that last point that I'm really interested in. The Federal Reserve for the month of October could be flying blind.
Yeah, they could be flying blind. I mean, you would hope that they have access to some other sort of data points that they could keep an eye on. I don't know. Who knows how that works? But it is going to become a big issue here if it is prolonged here, because it kind of disrupts everything. It's sort of like dominoes, right? You just can't take one piece out of the equation and not have it affect the others. Absolutely.
And of course, the length of time that we're talking about. If we get something similar to the 2018 experience, 35 days then we'd be having a much different conversation than maybe just a day or two.
And there were those comments by Neil Kashkari on CNN network, I believe, where he kind of talked about this idea that the Fed's calculus would change big time should there actually be a shutdown that lasted more than a week or two.
Yeah, well, I'm sure we're going to spend plenty of time talking about that today. But still ahead on the close, we've got to talk about Micron. It's out with its fourth quarter results later today. We'll get more perspective from the sell side about the market's appetite for memory chip products. This is Bloomberg.
Let's get a view from the sell side with our top calls. The big movers on the back of analyst recommendations. And we start off with Zions Bancorp, a downgrade to underweight over at Morgan Stanley, which warned that mid-cap banks are not out of the woods yet from the March banking crisis. The analyst says the upcoming earnings season could be a sell the news event as deposit growth slows. Shares of Zions down about 1% on the day. Next up, let's take a look at International Paper, upgraded to hold from underperform. This over at Jefferies, with the analyst saying that while the supply-demand balance still remains mixed, the cyclical bottom for the packaging industry may actually be near, and he advised investors to cover their shorts. Those shares higher by about 1% on the day. And finally, WW International getting a lift today over at Craig Hallam to hold as enthusiasm for weight loss drugs, those prescription weight loss drugs, dominates the space, calling it a, quote, artificial intelligence moment for the healthcare sector. He says that while progress may be slow, the analyst believes that WW could play a key role in that landscape and even leverage some of the partnerships it has with the health insurers. A fantastic day, 9% gain for WW, and those are some of our top calls. We want to stay in the sell side space and push ahead to some earnings coming after the bell tonight. Micron, the chip maker, set to report, and there are a lot of expectations here about where we are right now in the memory chip recovery cycle. Brian Chin joining us right now, technology analyst over at Stifel. Brian, let's start there here, because so much of, I guess, the fortunes of this company, and more importantly, the expectations of investors, are going to be predicated on where they think we are right now in that memory chip cycle. Where are we?
Yeah, well, thanks for having me today. And so semiconductors, clearly a cyclical industry. And then when it comes to memory chips, and that's principally what Micron does, certainly they fit the bill. If you look at where we were about a year ago, revenue's down 55 to 60% from the peak. Micron was printing $2 per quarter positive EPS. A couple quarters ago, they lost nearly $2 per quarter. And so I think the good news here is that conditions should be past the worst. Gross margins are still negative. We think losses in the P&L should persist, but at this stage, ultimately, whether Micron's losing 90 cents, $1, $1.10, I think that's kind of really splitting hairs.
Yeah.
The important thing is really where pricing is going, as you kind of allude to, and that's the real swing in the cycle, and that's where we have some increased optimism.
Yeah, and just for our viewers, right now, on average, Lisa, by the folks we track here, investors expecting about $1.18 adjusted loss per share on revenue of about $3.93 billion for the quarter. Brian, of course, everyone is going to want to know sort of what Micron's stake is in this sort of AI boom, this AI revolution, if you will. There hasn't been a lot of talk about Micron in that space. Do they have a space in that area?
Yeah, so this has clearly been a bit of a rub against the stock and the company. They had back kind of a different technology. Again, just to rewind, the type of memory we're talking about here is called HBM, or high bandwidth memory. And that's really kind of main memory specific to the GPU used for AI compute. And so the Koreans tend to have an advantage or lead time against Micron in these areas. But that's actually one of the encouraging data points we picked up. We heard that they've actually started to place orders with some suppliers. And so even though that's not maybe a guarantee that they've won business here, it certainly is a positive indication, I think, of them gaining traction and having the conviction to start to increase capacity and output next year, potentially, against this opportunity. So I think that's a bit of good news. We'll see if they have more to say about that tonight.
And assuming that they are able to increase that capacity, what kind of offset would that be for what's going on in the broader memory space if we truly aren't rebounding here?
Yes, that's why, certainly what we advocated in our note earlier this week was that we see a near-term opportunity to be overweight because of the potential optionality here to start to raise pricing. And now, the reason why it's somewhat of a lukewarm call and we still have a longer-term hold rating is that this is still largely a one-sided affair, meaning that it's much more supply than actually demand-driven at this point. But the good news is that over the past 12 months, I think we've certainly seen supply decelerate in terms of output of memory chips. Meanwhile, the biggest demand destruction and deceleration seemed to be in the prior 12 months. And so even though it's kind of hard to visualize per se, I think maybe this has crossed over where they've cut back too much. And we'll kind of see if that becomes leverage here in Q4.
Well, Brian, just focusing on the shares, they're up 35% year to date. You're a long-term hold, but a tactical short call here. How much further could Micron rally in the coming weeks and months?
Yeah, we've kind of said 10 or 15% plus sort of rally, and that would be sort of underpinned or underwritten by price increases to the contract rate against which they charge enterprise customers. There's been some movement in what's called a spot rate, which can be the domain of speculators and market makers, but not as good of a confirming signal. But if Samsung, if the other suppliers were actually able to raise pricing, I think that would certainly be a tailwind at the back here of the stock.
All right, Brian, great to catch up with you here. Brian Chin over at Stifel, a preview of what's ahead here. Micron set to report earnings after the bell tonight. Full coverage right here on The Close. In the meantime, we're going to have a conversation with Bill Curtin, Hogan Lovells partner and global head of M&A, to dive into how bankers are preparing for the end of recession fears and the increasing popularity of AI. This is Bloomberg. Welcome back to The Close. It's time now for our Wall Street Week Daily segment with the host of Wall Street Week, David Weston, who joins us every day around this time. And David, we know this hasn't been the greatest year for M&A and volumes here, but we know these things tend to be sort of economically cyclical, and I guess a pickup is going to come soon.
Well, exactly, Romaine. After all those record years, now we've had some fallow times, and the question is it coming back, and if so, when? To give some answers, we have the person who knows. He's Bill Curtin of Hogan Lovells, where he's global head of M&A. So, Bill, welcome back. Good to have you here. So, is there a pipeline building? How can we tell?
Yeah, it's coming back, right? We had the heydays of 2020, 2021, when we broke every record imaginable, both by volume and by value of M&A. And then it came down, and pretty dramatically, particularly on the value side. But I see the green shoots again. I see it. The bankers see it. We're preparing with the C-suite. We're looking at transactions again. And so I'm actually pretty optimistic. I'd call it measured optimism about the next 12 months that are in front of us.
If there is a pipeline building up, what is going to be required to release it? What is actually going to trigger the actual mergers and acquisitions?
Right, David. So we think about our reality right now, where we are. We have dramatically changing landscapes in how we move people, how we move things, how we catapult technology forward, energy transition. All of these things require non-organic activity in the form of M&A, right? So we have these amazing propellers that are happening. On the other hand, we have a lot of headwinds in front of us. We have regulatory headwinds in front of us. We have financing headwinds in front of us. On the regulatory side, we have very active, engaged antitrust officials and regulators. We have more expensive debt in the market, harder to secure debt in the market. And then we also have national security concerns. So I think about it. I was at LaGuardia the other day, David and Romaine, and I don't know if this has ever happened to you, but we were stuck on the runway for quite some time waiting to be given permission to take off. And I think about all those planes on the runway as M&A deals. And I think about the C-suite in the cockpit and telling us, hey, when can we take off, and how high do we fly? Where do we fly? Because there are these headwinds out there, but we have to go. And that have to go is because of the technology propellers that are occurring and all the dynamism in the marketplace.
Well, let's talk about some of those areas then. I mean, obviously AI, artificial intelligence, has been sort of the shiny new object here. And there's been a lot of discussion that, particularly on the periphery of that, not just the core chips that go into this, on the periphery of that, there's an entire ecosystem that is going to be ripe for M&A activity. Are you already seeing that?
Yeah, so look, Cisco made their move with Splunk, right? And everybody took note of that. And we know that Amazon and Google are both looking as well. and they're investing in this space, and it's a reality now. 6 months ago, you had to talk about AI, or else you watched your earnings, right? In your Qs, you would have a problem, right? So the CFOs all talked about it. Now they have to implement it, and they have to implement it meaningfully. So I expect a lot of transactional activity there, Romaine, by definition, because you can't do it organically, right? The R&D investment, the quantum and the amount of time is such that you need to do that through M&A. So I see that. I also see a lot in the mobility space. I see a lot in the EV space. You know, if you think about all these oxymorons right now pushing us toward more M&A, notwithstanding the headwinds, the 15 districts in the United States of America that have received the most investment for EV under the IRA, guess what? They're all Republican districts. Every one of them is a Republican district. They're in the South, the Southeast, rural areas. They love this influx of capital and investment and job opportunities. So we have all these propellers moving us forward, and we just have to find a way to navigate through the FTC, the DOJ, the National Security Department, and like.
Well, let's talk about that, because as you know, the environment for M&A deals from a regulatory standpoint is way different than what it was even just a few years ago, maybe 3 or 4 years ago here. And I'm curious as to how you square that circle, because we're not just talking about, oh, we're just going to look at the behemoths and block a deal if we think there's a monopoly. They're looking at smaller deals now and saying, could this be a monopoly in the future, and maybe we should nip it in the bud now.
You said it exactly right, Romaine. It's incredibly prospective, the way the regulators in Washington, D.C., and in Brussels, and in London. Because, of course, London's got their own CMA now as a result of Brexit and the like. So you have a triangle there, right? And they're prospective policy making in the way that they're reviewing and scrutinizing mergers, right? We have the draft regulations that are now out, that are under review, and they haven't gone final. They're open to comment. The regulations look, just as you said, Romaine, so different than what we had before. Before, it was about market power, pricing control, right? Now it's about, are you transacting in a way that makes things less competitive? And the proposed rules even talk about what less competitive means. Not as good for the labor force, preventing nascent technologies from coming into play, or even pursuing serial transactors. Think about that. You do M&A on a recurring basis, and you're subject to more scrutiny.
Private equity, as President Biden has talked about, right? But we had Lina Khan, the chair of the FTC, on Bloomberg yesterday, and she said she's as concerned about the deterrent effect as actually winning cases. She's lost some big cases, as you and I both know. Is she having that deterrent effect in your experience as you talk to CEOs and CFOs?
I expect less and less. My view is that will
less and less deterrence.
Less and less deterrence. More and more activity going forward. What I hear from the C-suite right now is not whether we can do a transaction, David, how we can do the transaction. So increasingly, these deals are getting lined up for 2024. That's why I'm measured optimism for 2024, with the C-suite saying, we want to get over that mountain there. We want to bring in that capability. We want a joint venture in that geography. Tell us how we can do it, not whether. 6 to 12 months ago, David, it was more whether. Can we? Will we get blocked? Will we be sued by the United States government and lose? Now they're more inclined to say, just tell us how to do it, because we believe we can, right? So the track record here with cases settling, cases being lost by the United States government, are such that there's more of a sense of confidence and more of a sense of let's go.
Bill, one question is, can we do the deal? Another is, can we afford to do the deal? We now have rates higher. We have yields higher. How big an impediment is that to this pipeline really getting unleashed?
It's significant. It's real. It's gotten more expensive, right? We heard Jamie come on, on your show. You've had wonderful guests who've come on and even talked about the possibility of a 7% environment out there. We think, Romaine, it'll be more like 5.5 to 6, but we'll see. It's more expensive. And with that, David, at the same time, it affects valuations, right? Because the valuations out there have to get reset to accommodate the more expensive nature of the acquisition financing. And when the valuations get reset, the sellers, who are quite proud of their assets, get a little bit less inclined to part ways with their assets.
But this also goes back to the whole idea of the pipeline and your analogy of the planes on the runway. I mean, some of the big deals that we've seen this year have been largely cash deals.
Yes.
We haven't seen as much financing and even use of stock, not quite as much as what we have seen in the past.
That's right. Well, there's so much cash that's been stockpiled.
Okay.
So what I think is really interesting, to your point, Romaine, is people learned from 07, 08, right? And people froze after that moment in the M&A community. We just stopped. Well, this time around, what have people done? They've continued to work on their balance sheets, right? And because those balance sheets at this moment are so much stronger, the strategics and, of course, the dry powder rich sponsors are ready to go. They've just been waiting, as David said, to see that the skies are friendly.
Yeah.
And if the skies aren't friendly, they don't want to take off. So you have a lot of planes at LaGuardia, right? Today's a beautiful day in Manhattan.
Yeah.
But there have been a lot of planes that are looking, and those planes are fueled, staffed, and ready. And I think we're going to see more of them lifting and navigating the obstacles.
I love your airline analogy, but I wish you would have picked a more efficient airport than LaGuardia.
I do like the new terminal.
It is nice.
Okay, thank you so much to Bill Curtin, Hogan Lovells partner and global head of M&A. And tomorrow, we're going to be joined by our crowd founder and CEO, John Medved, to discuss the impact potentially of an Israeli-Saudi deal, what that could mean for the Middle East and for global growth overall. Then on Friday, we're going to hear from Ruchir Sharma of Rockefeller International on Wall Street Week at 6 p.m. Eastern Time, talking about whether, in fact, the United States has basically had its best shot at stimulating its economy. That's coming at 6 o'clock on Friday.
All right, and we're actually going to talk a little bit about that in just a bit here. David Weston, of course, joins us every day around this time for our Wall Street Week daily segment as we round out into the final hour of trading here on The Close. A focus on the potential of a government shutdown, a new product by Meta that's not moving the needle. Yields right now hitting new multi-year highs, and take a look at crude oil here. A lot of factors moving this market. Romaine Bostick alongside Katie Greifeld. This is The Close on Bloomberg. Almost 3 p.m. here in New York. This is the countdown to The Close. I'm Romaine Bostick.
And I'm Katie Greifeld.
Another mixed day here for markets. We've been kind of oscillating between gains and losses here, but coming off of what was a huge sell-off yesterday here, you're not really seeing a whole lot of juice here coming into the market on this Wednesday.
Yeah, surprisingly calm day in equities, even though there's still plenty of action in the bond market. I remember this morning, feels like a long time ago, yields were actually lower only to spike higher, and once again, we're at cycle highs.
Yeah, the volatility, I think, is really vexing a lot of people. Interesting, probably the biggest mover here, at least on a sector basis, is what we're seeing in the energy space. XOP up more than 3% on the day. And of course, that's a big part of the reason why you're seeing the Russell up about 1. Flip up the board because you're also seeing the VIX higher on the day. At one point on the day, it actually traded close to 20. It's now come down just a little bit, right around 18.5, but the trend line is clearly there. The blue line there, your 200-day moving average, it has broken above that. The other line on your screen there is option adjusted spread on the U.S. dollar high yield, and that is moving higher as well here. And I think that's causing a lot of agita.
So maybe we're seeing some ripples in those markets, but both in high yield and when you look at the VIX, it's been very, very calm against when you lay that against what we're seeing in the Treasury market and some of the volatility indexes there. But let's talk about some single stocks because there's some interesting movers today. I want to start with Palantir. Palantir rallying today. It was awarded a U.S. Army contract valued at up to $250 million. It's going to conduct research, development services in AI and machine learning. And remember, U.S. government contract orders make up about 6.2% of Palantir's revenue. So big deal.
Yeah, big deal. And of course, I mean, I hate to bring it up, but we're all talking about a government shutdown and how these government contracts get affected. Obviously, these are long-term contracts. So even if there is a break in payments in the short term, they get it back at some point in theory. Yeah,
shareholders today determined not to think about that. Palantir shares higher. Let's talk about Sirius. This is an interesting story. Liberty Media, it's proposed splitting off the business that houses SiriusXM and combining it with the rest of SiriusXM Holdings. Shares up about 4.3%. So Liberty, it owns 83% of SiriusXM in tracking stock. But Bloomberg Intelligence says that the idea behind this combination is to narrow the discount between SiriusXM and the tracking stock.
All right. Well, I guess this is my daily reminder that Liberty Media is still a public company. I saw you had Cody on there as well. And that stock has really been all over the place the last few days.
It has. Right now, it's lower because it's launching an offering of 33 million shares. That's part of its plan to list in Paris on the Euronext Paris. And this stock offering, it would be valued at about $389 million based on Cody's closing price. But of course, you talk about a stock offering, you have shares lower. But this is an IPO. I would be very interested to see how it's received.
All right. But in the short term, this is more of a dilution story right now, at least for existing investors.
Exactly.
All right. Well, those shares are down for a fourth straight day. Meanwhile, the market's trying to poke back into the green after being in the red for a good portion of the day as we are less than 1 hour away from the closing bell. Our cross-platform coverage counting you down to the close. It starts right now.
Countdown to the close. Bloomberg's comprehensive cross-platform coverage ahead of the U.S. market close starts right now.
This is the countdown to the close. Romaine Bostick alongside Katie Greifeld. We're joined right now by our colleagues Carol Massar and Tim Stenovic. Welcome to our audiences across all of our Bloomberg platforms, television, radio, YouTube, and originals. Carol, another wild day here in the market. I want you to take a close look at your Bloomberg terminal right now and tell me exactly
I'm
what
looking.
is going
Are you
on.
doing that because you know I have computer problems?
Oh, goodness.
I am nothing but a troll, Carol.
You are, man. You are.
Carol doesn't need a computer to do this.
Oh, my God. Well, we are rounding off our worst levels when it comes to the equity trade. So I actually have my Bloomberg up and running because you know what? You can always count on your Bloomberg to be there. Having said that, man, what's going on over at Meta? I thought the metaverse was it. What they're doing really is focusing on chatbots all of a sudden because I feel like they're getting bitten by the AI bug. It feels like everybody's getting bitten by the AI bug, including that Hollywood contract, the writer's contract. There is a provision in there, Tim.
Yeah, the writers, Hollywood writers, are actually winning on a promise that no robots are going to get screen credits. We should note that this was one of the main sticking points over the last 5 months, Romaine.
Yeah.
But, you know, we're starting to get some details of what the writers are getting and what the studios are actually getting.
They don't get screen credit, so do they get to still write the scripts? They just don't get credit for them?
No.
First,
no, they get to get trained on scripts, so they can train AI using old scripts, which is actually a really contentious issue and something
rules,
the writers
right?
did not want. Yeah, there's rules laid out.
Governing the use of AI. First, I think contract to do so.
How do the robots feel about this?
We haven't asked them.
Okay.
Yeah.
They're going to form their own union.
They're coming for you, Romaine, right now, apparently, because they're a little upset about, you know.
They're coming for Romaine. They're coming for all of us. But let's talk about ghost jobs. We're roughly a month away from Halloween.
Who's picking these topics, by the way?
We picked this one together.
It has a Katie feel, don't you think?
It sounds spooky.
Taylor,
It is spooky. Let me tell you about it. So government data indicates that there's about 9 million jobs available in the U.S. right now, but increasingly,
That's good, right?
well, you have job seekers becoming frustrated because they're being ghosted by these employers. There's this growing feeling that a lot of these companies with openings don't actually intend to fill all of those jobs, and that casts some skepticism over that JOLTS data that we analyze all the time when we talk about this tight labor market and still so much demand for workers. If this is real, this ghost job trend, it would place a question mark at the end of that.
I'm confused, though. Like, what's the incentive for them to do that? To list, basically.
I was asking the same question, so I called up Molly Smith, who wrote this story along with Matt Boyle.
That's good. That's proactive.
And she said,
wow.
I just wait till I come on the show here and ask.
That's what we do.
You're waiting
We're
for the
reporters.
robots to come up.
And she said there are kind of three things going on right now. One is that a lot of HR departments were thinned out over the last few months when people have gotten laid off. Two, the balance of power is changing when it comes to employees and employers. So now employers don't actually have to call employees back if they find someone else to fill it. Remember, employees were in the driver's seat for so long in this post-pandemic economy. That's not happening anymore.
Yeah, I mean, and that's really been the big question. We've talked about this a lot, of course, on the summer of strikes, and of course the strikes that still exist here. This idea here is that whether the leverage that labor unions and really workers overall have had over the last couple of years, whether that's finally waning.
And that's why it's so interesting to see all of these strikes really come to a boil over the past few months, because the labor market has been very strong for years now, and maybe employers are getting a little more leverage back, but still you have the unemployment rate under 4%. That's still very hot.
Yeah, it certainly feels that way. But we do care, because if this is what's going on and maybe those openings aren't really accurate, maybe the labor force is ultimately not as tight as we all thought. Anyway, all right, we're going to come back.
I mean, I saw a post for a news anchor, and well, I mean, I guess maybe that's a ghost. We don't need to worry.
For business, for Bloomberg Business Week?
I don't know. I can't tell you, Carol.
Don't ghost me. All right, guys, we're going to be back in less than an hour's time. Our cross-platform, we will continue counting you down to the close on this Wednesday. Radio, TV, YouTube, Bloomberg Originals. Join us for Beyond the Bell at 4 p.m. Wall Street time.
And we continue our coverage right here on the close, counting you down to those bells, just a little bit more than 50 minutes away. Interesting note out by Ned Davis, ditching its call to buy into big tech. Strategists there are cutting the group from the equivalent of a buy, a stance it's held since March. Instead, is looking at the communication services sector as the growth sector to overweight instead. Let's get some perspective out of our next guest. Heather Brilliant. She's a CEO and president over at Diamond Hill. Pleased to say she joins us here in Studio 2 at our Bloomberg World Headquarters. Great to see you, Heather.
Thanks for having me, Romaine.
Let's talk a little bit about the tech sector, because, of course, that was kind of the saving grace for this market in the first few months of this year. Is there any sort of juice left in that trade?
It's really hard to say. I think if you take a long-term perspective and you look at some of the valuations of these companies, they are very challenging at these levels. So I wouldn't be surprised to see some weakness. But, you know, we take such a long-term perspective. I'm really talking over the next couple of years as opposed to, you know, next week or something.
Well, let's talk then about kind of where we are now and where we might be in a couple of years. I mean, we're in the middle of what's going to shape up to be a pretty bad month for not just stocks in the U.S., but globally overall. And I feel like a lot of investors are really starting to question where we are in this economic cycle or the business cycle or the market cycle. Are we at some inflection point where we're off to new and better things? Or is this the start of maybe a downturn that they're going to have to contend with?
I do feel like over the course of the last month or two, we've had a lot of reckoning with the idea that rates are not going back down to the historic lows that we've experienced over the last couple of years. And so from that, I think you can conclude that there's still a lot of questions about whether the economy, you know, as you mentioned, goes into a weaker period or not. Fortunately, a lot of stocks are pricing in some level of a downturn. And I think since that's already priced in, there's some real opportunities from a valuation perspective.
Where do you see those opportunities? When you think about some of the stocks that have already priced in that reality, where are you seeing some of those opportunities open up?
One of the ones I would mention is Regal Rexnord. It is a manufacturer of things like motors that go into industrial faculties, or facilities, I should say. And essentially, what you're seeing from a company like that is that there is some economic downturn priced in or expected when you look at the valuation. It's very undemanding at these levels, but they are not a highly levered company, and they will really benefit from onshoring and trends that I think will provide tailwinds to a business like that. So as long as you can take a couple-year view and really look beyond whatever downturn we may experience over the next, you know, couple quarters, couple years, whatever it ends up being, I think there's a real opportunity there.
There's a real opportunity there. And on the flip side, let's ask the opposite question. I mean, what kind of areas would you avoid right now? When you think about maybe, okay, some of these sectors, some of these names, they have priced in a recession. Where do you think there's still that disconnect between what's going on in the economy and fundamentals and where valuations are?
I mean, thematically, I'd say we would always suggest avoiding areas of the market where the valuations are really challenging and demanding. And I think, you know, to Romaine's point from earlier, that really does happen right now in the tech sector, where you've seen so much of the market appreciation that has happened. Even if you look at the market year to date, there's still a lot of strength. And so much of that has come from technology. I think that those valuations are super demanding and would be very challenging to make a case for at this point.
I want to go back to some of your picks. They had just shown us a full screen here of some of the stock picks that you had up there. Regal Rexnord was on there, Ferguson here, and they're a company that I'm actually not familiar with, Dino Polska. A, can you explain what those are? And also, can you explain why there are no U.S. companies on that list?
Well, Regal Rexnord is a U.S. company.
Okay.
And Ferguson, while it is technically, you know, it technically has a headquarter outside the U.S., it's actually listed on the New York Stock Exchange.
Okay, all right.
But it does fall a little under the radar as a result of that, which is one of the reasons I think it's interesting. So Ferguson in particular is super interesting because it's a distribution business. And so essentially they take very fragmented suppliers and very fragmented buyers within the plumbing industry and match them up together. And so in all of the categories they operate, about 75% of their revenue comes from categories where they're number one or two in their market, but that still gives them less than 10% market share. So there's so much room for them to continue to provide value to those suppliers and those buyers. And because they're bigger than so many of their other other competitors, they have the opportunity, and they have been investing much more heavily in technology, which gives them an edge as well.
And then what about Dino Polska? That's basically a supermarket chain, right?
It is, yes, exactly. So
I mean, we all eat, so but is that a good investment?
So it's based in Poland. Poland, and there's a couple of reasons we think it's a good investment. It's a very well-run in business where the family who founded it is very involved in the company still to this day, which is generally a really good sign, especially in the market in Poland. Also, that is a very fragmented market. If you look across Poland, more than 65% of the population lives in pretty small towns, and what Dino Polska does is essentially small format stores in smaller towns. So they have a huge runway to continue to grow, and we really don't think that's priced in.
Can we back up a little bit? Because, okay, maybe Romaine wasn't familiar with one of those names. I didn't know any of those names.
Okay, I feel better now.
Good, I love that I brought some new ideas.
Well, what does your process look like? What screens are you using? What filters are you using to catch a Polish grocery store?
So we have a couple different strategies that look at, essentially one strategy looks particularly at international markets, and that's how we came across the Polish grocery store, to be fair. But there are some elements that we really consider across all our strategies, and the number one is valuation. The challenging thing is that if you look at valuation on like a PE basis, you're going to miss a lot. And so what we really try to do is to look for companies that are trading at a discount to intrinsic value. So we're estimating the cash flows of all the businesses we think look even remotely interesting, and then trying to find out which ones are trading at a discount to that.
All right. Well, this was eye-opening, Heather.
It's eye-opening.
Really?
You know, she's smart. That's why she knows that. You know, she's a Northwestern grad, by the way.
I would believe it.
And you went to Chicago.
And my reunion is coming up.
There you go.
Okay. All right. All right. Well,
I mean, not to brag.
Starting to feel a little excluded here. Heather, it's great to see you. Come back soon. That is Heather Brilliant, CEO and president over at Diamond Hill. Now, coming up on the close, how a U.S. government shutdown could affect the Fed's next rate decision. We'll discuss that next with Jerome Schneider. He is head of short-term portfolio management and funding at PIMCO.
And Meta. It's unveiling its newest VR headset as it prepares to face competition from Apple. We're going to talk about the battle line shaping up in the virtual reality wars.
And breaking news, why singer Katy Perry is in a fight with the founder of 1-800-Flowers over a $15 million home. All that and more coming up.
Oh, boy.
This is Bloomberg.
That's a nice house. Welcome back to The Close. It's time now for our Muni Moment. And a new report says 12 U.S. states could be at risk of cutting or scaling back essential programs when the federal government's historic stimulus package expires in 2026. Joining us to discuss the outlook for munis is Ben Barber, Senior Vice President and Director of Municipal Bonds at Franklin Templeton Fixed Income, which has more than $135 billion in assets under management. And let's start there. I know we're kind of looking a little bit further out here, Ben, but do you see any potential for disruption out there?
Well, it's a great question, and thanks for having me on. You know, I think the credit fundamental story in munis is one of the most compelling stories that we've got in the municipal market. As probably a lot of people know, in 2022, credit fundamentals were very, very positive across most of your traditional municipal sectors. Of course, there's state general obligations, there's city and county general obligations sectors, but there's also acute care hospitals, transportation, utilities, education, et cetera. So there are literally over dozens of sectors involved in the municipal market, all of which operate in different formats and different portions of the credit cycle. So when you do have government slowdown, it's interesting to note in the muni market, it doesn't really impact all of the sectors at the same time. A lot of diversification.
I am curious about the state of investor appetite right now in the muni space. I mean, we saw a lot of outflows early this year out of some of the key funds here. And I don't know if that had to do with concerns about economic conditions, or maybe it was just competition from returns that you can get in other investments. But where do we stand right now?
Yeah, I think one of the most compelling stories in the muni market right now is just the high absolute yields. You really have to go back to taper tantrum, fall of 2013 to pick up yields like we're able to pick up in today's market. So just a couple of data points there. 30-year AAA munis right now are yielding a little bit more than 4.3%. And as you know, the municipal market's a very high credit quality asset class. If you go down the investment grade credit spectrum, down into the AA, single A, triple B portion of the municipal market, those yields are north of 5% for the triple B index, which on a taxable equivalent basis is north of 8%. So it's a very compelling opportunity right now, just from an absolute yield perspective for munis. You're absolutely right that open-end fund flows were very negative in 2022. They've stabilized somewhat in 23, but we think there's a lot of cash sitting on the sidelines waiting for these opportunities.
Well, Ben, that's what I wanted to talk about. What are munis competing with? Are they competing with money market mutual funds? Are people just happy to sit in cash where they can get comparable, if not higher yields?
Yeah, absolutely. They're very happy sitting in cash. So I'd say that's the number one piece of competition for the municipal market is, investors just sitting in money markets or cash equivalent type of investments. We have seen a lot of interest over the last couple of weeks and months as these yields have just continued to rise for people pushing out from cash and cash equivalents into the fixed income markets to get a little bit more normal asset allocation. We think one of the big positive catalysts for flows really to come back into the municipal market will be the yield curve inversion flattening, and then ultimately getting to a much more normal upward sloping nature to the yield curve. And we've seen some steepening here just even over the last couple of weeks.
Yeah, and that's actually what I was wondering. What actually will be the catalyst? Is it yields on cash and some of these short-dated, very safe instruments coming down, or is it long-end yields actually getting to a point where people can't resist?
Yeah, I think it's a very good question, and I think the FOMO, the fear of missing out that investors have sitting in cash if they miss this opportunity to invest out the yield curve and lock in some of these really attractive rates will be very real. So I think the muni market is uniquely inefficient because it's a retail-driven asset class. It's not really an institutionally driven asset class. So being a retail-driven asset class, it tends to be more inefficient. So when the moves happen, they tend to happen very, very quickly. And so with any sort of flattening to the yield curve or an upward sloping nature to the yield curve, I think that'll be a very positive catalyst for money flowing right back into open-end funds in particular.
All right, great insights here, Ben. Ben Barber there, Director of Municipal Bonds at Franklin Templeton Fixed Income here for our Muni Moment, Katie Greifeld, on a Wednesday afternoon where we're seeing the broader market, which when we started this show about an hour or so ago, was deep in the red, and it looks like we were headed for another down day. But now everything pushing back into the green, believe it or not, led by the Russell 2000, up more than 1%.
Well, I have the same question about stocks I do have about the bond market.
Oh, yeah?
What's driving it?
Yeah.
I don't know. For stocks, did anything fundamentally change in the last hour and a half? Probably not.
Probably not. There's so many knee-jerk reactions here. Everyone's trying to piece together a narrative, but how do you do that when you have the dollar on a tear, when you have yields continuing to go higher? And you're seeing right there on there, one of the main indices that tracks the Chinese property developers down again. Katie Greifeld, do you not care what's going on in China property market?
I also care about oil.
Do you?
Yeah.
Okay. Well, you got to fill up that big gas guzzler that you drive to work every day. Stick with us. We'll be back in a moment. This is Bloomberg.
Well, pop star Katy Perry, the other Katy, she's heading to court with the founder of 1-800-Flowers, Carl Westcott, all over a $15 million house in Montecito. Now, Perry and Westcott are feuding over the ownership of the estate. Westcott says he never wanted to sell his home. He was not of sound mind when he inked the deal. And Perry, she's not walking away from the purchase. She's expected to take the stand as soon as Friday. And Romaine, we're talking about an 8-bedroom, 11-bathroom estate. Sprawls over nearly 9 acres.
It looks nice here. I'm a little confused about the dispute here. He bought this place back in 2020, then put it back on the market a couple months later, signed this deal with Katy Perry, or at least her people who run her finances here, and now he had regrets.
He's saying that he was on painkillers at the time, and he wasn't of a sound mind. And
who isn't? I don't know. It's a contract, right?
I know. And so apparently they're going to court.
How is this in court? Either he had the right or the cognitive ability to sign this, or he didn't, right?
I know that we're focused on the shutdown and that Saturday deadline, but
is this the more important story?
I don't know. It starts on Friday, so we'll see what the news cycle is. But I agree. It does seem pretty clear cut, but who am I? I'm just the other Katy.
Does Katy Perry not have a home?
I don't know.
Does she really need this one?
Her and Orlando Bloom.
Who's Orlando Bloom? That's her husband?
Her partner.
Okay.
He was in Pirates of the Caribbean.
Yeah.
Very handsome. Legolas.
Not the The other, not the Johnny Depp guy.
No.
The other one.
No, the other guy.
Yeah, Johnny Depp.
In any case.
Johnny Depp was just on trial for something too, wasn't he?
This is Bloomberg.
This is the countdown to the close. About 30 minutes left to go here in the trading day, Katie. Another interesting day for equity markets, continue to be battered around by higher yields and a higher dollar.
Going back and forth right now, the S&P 500, it's in the green. You take a look at the sector level. It's pretty much an even split. As you can see, energy up top makes sense when you have crude oil off to the races. Energy up by about 2.6%. Industrials getting in on the action, as too is communication services. That's the good news. You go down the list, look at what is not doing too well today. Healthcare, consumer staples, and then utilities at the bottom, off by 1.7%. Interesting to see consumer staples and utilities really taking it on the chin today. Romaine, typically those are your defensive sectors.
Yeah, absolutely. Here, when we talk about some of those defensive sectors, at least for right now, the defensive sector is going to be the energy space. Occidental Petroleum up 4% here. But then you look at some other names in the energy space, like NextEra Energy, on the back of some guidance that really caused some concerns amongst investors. Those shares down about 8% here, one of the biggest decliners in the S&P here on this day. And Mattel, though, getting a boost. Interesting note out here from the sell side here, saying that there is a potential here for a rebound in some of these consumer names, particularly those like Mattel and Hasbro here, as we get deeper into what here in the U.S. at least is a traditional holiday shopping season. But if you're looking for that canary in the coal mine, you actually might find it in the consumer discretionary space. Remember, that was the big outperformer earlier this year, but that has flipped a big time. The bloom has really come off the rose. In fact, the consumer discretionary sector in the S&P now on setting up for what's going to be a 7% drop here in the month of September. Worst drop all year long here. And a lot of people are saying that when you look at some of the concerns about a government shutdown, the resumption of student loan payments, and concerns here about credit card balances and just how much cash is really in the pockets of some of these households here, the main pillar of this economy, remember, the bulk of our GDP coming from consumer spending and a lot of it from the discretionary side. If investors don't think that's going to hold up, it makes you wonder what's going to happen with the rest of the market.
Well, let's go from that sector back to the bond market and what to expect next from the Fed, including how a government shutdown could affect monetary policy. Joining us now, I'm thrilled to say, is Jerome Schneider. He is Managing Director and Head of Short-Term Portfolio Management and Funding at PIMCO. And actually, Jerome, I want to start on the long end of the curve because the moves that we're seeing have been pretty staggering. We're at cycle highs across the curve, particularly at the long end. And when you look at that and you look at the pace of the moves that we're making, have we moved beyond fundamentals? Is there something else going on driving these moves?
Yeah, Katie, good to be with you here today. We believe that there is obviously a significant move to be had. It's driven by some volatility, some recalibration in inflationary expectations for a little bit longer. That's been propelled by the recent discussions within the Federal Reserve. But ultimately, investors have been preparing and are continuing to prepare for a higher for longer scenario, at least for the immediate future. And what that means is two things. Number one, that term premiums, meaning the shape of the yield curve and the premium you should demand for being in longer maturities, continues to recalibrate higher, and that's denoted by the reinflation, if you will, of the 2s-10 spread by moving more than 30 basis points in recent weeks. And the second thing, ultimately, is liquidity premiums. The notion of having the amount of cash and what liquidity is worth in the marketplace has continued to move higher. And as a result, what the investors are really telling you is that they believe the Fed is going to be on hold for a reasonable period at this point in time. They need to be paying or achieving higher yields in this regard. And fundamentally, the fixed income universe is much more attractive than it was even a few weeks ago as a result. And so that balance is sort of a healthy recalibration and rationalizing what the Federal Reserve continues to tell investors, to be vigilant, to focus on the possibility of a soft landing, but at the same time, trying to avoid the tail risks of longer-term inflation outlooks that will remain higher than expected.
So to the point that fixed income is more attractive than it has been, of course, yields at 15-year highs will do that. But then you think about the volatility that's coming from fixed income. I think it's safe to say the Treasury market has been a lot more volatile than the stock market. The fact that what's supposed to be the ballast of your portfolio, the volatility dampening part, what does it mean that that's actually where a lot of the volatility is coming from?
Well, that might be true in the microcosm of hour-to-hour, day-to-day moves that we witnessed over the past few weeks. But what I think we have to look at is the portfolio composition as a whole. And historically, the equity volatility tends to be much more profound than the fixed income volatility. We actually look at equities, we actually look at the fixed income balance in the portfolio as being a diversifier and specifically actually helping to reduce portfolio volatility. Well, how is that? We specifically look at the difference in how we achieve returns. And in this world where we are today, those returns are achieved by earning income, by receiving distributions and coupons that right now are in excess of 5%. And as a result, portfolios have a lot of cushion within that fixed income universe that helps reduce the volatility profile of their portfolios and actually not increase it. And so while you may not necessarily have the precise entry point of knowing where the 10-year note is today, tomorrow, or the next few weeks, the recalibration of where we are in the range of 4.5% right now presents a really interesting opportunity for investors to increase those distributions and actually reduce the volatility in a portfolio, especially given the uncertainties we see in the economic outlook that might still be a tail risk to investors' portfolios over the cyclical horizon.
Well, let's talk about that uncertainty. And I guess one part of that some people seem to think is certain, which is that the Fed isn't done, or at least it's certainly not going to cut rates anytime soon. How does that change, if at all, the general calculus here, or what you hold?
Well, part of the calculus is what we see obviously going in the marketplace with the rates moving to the higher end of our spectrum of what we believe at PIMCO. But at the same time, what we think is a critical juncture for investors who have been typically underweight fixed income for many years at this point in time to begin to rethink the value of fixed income in their portfolios. And the initial impact is to think about how to move to cash, put that to work, and then move slightly beyond those spectrums. We think that there's an opportunity, no matter which way the Federal Reserve moves, by being in the front end of the yield curve potentially. And the way we think about it is there's three different outcomes. The first one is the Fed remains on hold for a foreseeable future. In that case, you're going to earn an above market premium by being at the front end of the yield curve compared to money market funds, often in times of 100 basis points or more. So those returns are about 6.5%. In a rate hike, you're also being more defensive by immunizing your portfolio to the mark-to-market risk, and at the same time earning the higher yields by being in instruments like floating rate notes. And the third element is, should you have an unforeseen shock where the Federal Reserve actually has to cut rates, you're going to have the ability to reinvest cash and have already reinvested cash with much longer duration than being in a money market fund, which will recalibrate its yields immediately. So we view this as a thoughtful process where investors who have a lot of cash on the sidelines begin to dip their toe into that fixed income universe and potentially continue to move out the yield curve as they find opportunities and they get more comfortable with the yield outlook where we see it right now.
All right, Jerome, it's great to catch up with you. Really appreciate your time. Our thanks to Jerome Schneider of PIMCO. Now, coming up on the close, big news from Meta, which is looking to capitalize from consumer AI. Meanwhile, Snap is shuttering its augmented reality unit just 6 months after its launch. We're talking tech, rather, for our stocks of the hour. Up next, this is Bloomberg.
All right, time now for our stock of the hour. A broader look at the tech sector regarding the future of the social media space. Artificial intelligence and augmented reality could be the stars of the show, but two distinct companies, Meta and Snap, moving in different directions, both in terms of their stock price as well as their strategy going forward. Alex Barinka joining us right now to talk a little bit more about what we've learned. And Alex, let's start off here with the big event that Meta just held. Mark Zuckerberg taking the stage in that really tight T-shirt there, trying to explain why all these new features that he's rolling out for chatbots, et cetera, will somehow be the salve for their AI dreams. What did we learn today?
I'm here still at Meta, where he did roll that out in person. And there are two kind of really big buckets that Mark Zuckerberg was talking about here at their annual Connect conference. The first was virtual reality and mixed reality, like you mentioned. They released their new Quest headset, the Quest 3. It's a $500 headset that they're really pushing for mass appeal, trying to get everyone with this thinner headset to be spending more time not only in virtual reality, but there was a lot of talk today and a bit of a change of tone about mixed reality. Zuckerberg said you can put this headset on, look around your room, play games with your friends in both virtual and bringing these images into your real life. They also released a pair of Ray-Ban sunglasses with cameras on it that fits into their kind of hardware offerings. The other big talk of the day, which is quite a difference from what we heard out of Connect last year, is artificial intelligence. The company came out today and rolled out basically its first big slew of consumer-facing generative AI tools. Everything from the ability to create custom emojis or stickers in the Meta apps to chatbots, both a Meta AI chatbot that you can ask questions and it will search things for you in partnership with Microsoft's Bing, but also a number of celebrity face chatbots that are really specific. Yeah. You can
like
ask a character like real celebrities. Tom Brady, apparently this is his second act. You can ask a character called Brew about sports information, and Tom Brady's face is there in video format answering you with the help of generative AI. So a kind of a wide range of things here for Meta, really kind of showing both developers and consumers here at the event today and investors where their kind of big direction will be for the next couple of years.
Well, Alex, let's bring this to Snap, because you mentioned that Zuckerberg, his focus was on AR, on augmented reality. And then I'm looking at your byline. I see the news that Snap is shuttering its AR unit, just launched this year. So it seems like Meta is going into an area where Snap maybe hasn't been as successful.
Snap historically has been really strong on AR, and building on that success, they launched this unit called Ares, the augmented reality enterprise services business. They were trying to take the AR they're so good at in the Snapchat app through lenses, the puppy dog face you can put on your face, and build that into retailers' websites. Well, in the memo that I read and we wrote about this morning from CEO Evan Spiegel, he said that websites were too much of investment. It's too difficult. So they're cutting this business. They're losing about 170 people who worked for this business unit. And instead, they're retrenching on kind of the consumer-facing stuff. So this is really setting up an interesting standoff with Snap, who has been talking about augmented reality more than virtual reality, much more than Meta, who used to be all in on virtual reality. And now they're kind of running into each other here, one on Meta's headsets and the other on Snap's Snapchat app.
This does seem to be an issue, too, I guess, of who has the deeper pockets. I mean, Meta, at least in theory, can spend a lot, I guess, until investors finally try to clamp down on Zuckerberg. I mean, Snap, its R&D spending was just out of control.
It was, and analysts expect this for Snap to be their first yearly decline in revenue. So Snap has gone through kind of a retrenching, a reprioritization. They've killed a lot of business units. This was one of the few next to AI that actually made it out of a big refocusing year that they've had over the last 12 months. Meta, too, is in their year of efficiency, but they have been spending on record levels behind the scenes on things like artificial intelligence infrastructure and, of course, the metaverse, which is at times investors' favorite, but also least favorite story of the hour coming out of Meta Platforms.
All right, Alex Brink out at the Connect conference there at Meta's headquarters. A look at Meta and Snap, our stocks of the hour, as we move closer to these closing bells. Amy Kong, partner and wealth advisor at Corient, going to be joining us after the break. This is Bloomberg. This is the countdown to the close. I'm Romaine Bostick alongside Katie Greifeld here. Another interesting day in the markets. We were well off the lows of the day, but now off the highs of the day. Kind of a mixed day here, coming off what was one of the biggest sell-offs that we've seen all year yesterday.
Yeah, a mixed bag in the equity market, but the direction of travel clear in the bond market, of course, and that's yields higher.
Yields higher, the dollar up for a sixth straight day, longest winning streak for the Bloomberg Dollar Spot Index all year long. Gold also moving lower here on the day as inflation expectations and Fed expectations start to get adjusted. We should point out we are getting some earnings after the bell. Micron going to be coming up once we get to those closing bells. Full coverage right here on the close. We are just about 9 minutes away from those closing bells. Amy Kong joining us right now, partner and wealth advisor over at Corient, which has about $150 billion in assets under management. And Amy, let's start off with kind of this inflection point that we seem to be at. I don't know if people are making bets on economic conditions or they're just trying to make bets on what the Fed might do, or if there's something maybe more fundamental that's been driving the price action as of late.
Yeah, thanks for having me. I think you're absolutely right. There's obviously a lot of debate over the direction of the economy, given the Fed's more hawkish comments recently. At the same time, we are seeing a number of factors hit the system, whether it's strikes, whether it's student loans starting to become repaid again, or, in essence, a lot of different factors hitting the tape. And I think ultimately, because it's all hitting at the same time, the market's starting to lose a little bit of direction. And obviously, some of the froth that we've been seeing with this tech rally all year is starting to fade a little bit.
When we talk about sort of what moves equities right now, obviously the higher rates is certainly having an effect, the higher dollar also having an effect here. What matters more to you?
Ultimately, for us, it's earnings. And we are watching for a couple of things as earnings season is about to start in a couple of weeks. Given the hawkish comments that we have been hearing from the Fed, the dollar has ticked up a little bit higher. So that's a factor that we're paying more attention to as we head into the next earnings season. I think the shape of the consumer is also something that's worth watching. We've seen that they've been more resilient than ever this year. And as we are now getting into the back half of the year, we're starting to see a little bit of cracks in the system. The consumer is saving less, they're spending less, and as the student loans getting repaid is starting to pick up a little bit, we're actually seeing, Google search for words like restaurant reservations or airline tickets start to moderate a little bit, and I think that's going to start to impact companies forecasting what their earnings potential would look like, which is, I think, what's going to drive the markets.
Well, where does that appear in the stock market? What sectors would we start to see those cracks appear first when you talk about that slowing consumer?
Certainly, at the end of the day, we're watching the banks report first. They typically report as the first leg of the earnings season. We are watching loan growth. We're watching credit cards. Those are the things that will generally give us some bellwether metrics on the shape of the consumer. And as we edge closer and closer to the back half of the earnings season, of course, the retailers start to report, and you're looking at general spending on goods. But I think what we're looking for is services, which has been holding up the equation here. I think what's also something we're looking for is the fact that a lot of companies have been able to execute on pricing power. And I think that may start to lose a little bit of steam. And so we're watching for volume to come back, which I think is another very important metric to balance the act out.
And if we are maybe at the tail end of peak pricing power, what does that mean for some of these corporate margins that we focus on?
Yeah, margins are another thing that we are paying a lot of attention to. I think they've held up well, but as you've noted, considering that pricing power may start to slip up a little bit, we're also seeing that energy prices is starting to reverse course. Gasoline prices higher. I think ultimately that will translate into potentially higher input costs for manufacturing firms, et cetera. And ultimately, what we're also been very mindful of too is wage inflation, and that hasn't really moderated just yet. I've been encouraged that the quit rate, which is really the rate in which employees hop around in different jobs, has moderated back to pre-COVID levels. That's a good sign. And it's usually a leading indicator that wage inflation may moderate a little bit further. That could help buoy margins a little bit. But we are mindful that from an input cost standpoint, especially with energy prices now moving above 90, that could, of course, be a headwind for margins going into this next quarter.
I am curious, Amy, about what clients are asking you, both in terms of, I guess, where they should allocate, and more importantly, I guess, the type of returns that they expect in this environment.
It's gotten tougher, especially as the bond market and bond yields that we've been watching have continued to move higher. And so for us, it's a function of, one, rebalancing client portfolios between stocks and bonds, considering that bonds are now a more viable option than 18 months ago. Within the equity markets, we continue to focus more on longer term trends, whether it's shorter term, for example, which companies will benefit in a higher for longer environment, and which companies will benefit in longer term mega trends like AI, for example. And so fundamental research to us still makes a lot of sense. Pricing power, as I've mentioned just before, and those companies that can innovate, in our opinion, are the ones that typically can grow earnings in pretty tough environments, even if a recession were to hit.
What does innovation look like these days, though?
It can come in many forms, Romaine. I think one of the biggest hot topics this year has been AI, and that's something that we do think is a mega trend for us. AI can come in the form of just being able to support the development of AI, whether it's hyperscale vendors, whether it's just those companies that can enable the app developers, or it's just using AI in a different features or different opportunities, as we've seen lots of features coming out of Microsoft or Adobe. Those are, again, ways to monetize off of AI. We think that those avenues, if you would, are different ways of innovating. And as you've noted, and I'm sure we all are aware, AI does increase productivity, and it can obviously lighten the weight in terms of employee compensation.
Amy, does the promise of AI, does that help you look past some of the valuations on some of these names that are very involved in AI? I'm thinking a lot of these tech companies with very high valuations.
To a degree, yes, but ultimately we are still very mindful of valuation. So if the question was rephrased to, are you buying NVIDIA? The answer is probably no at these levels, but ultimately we are mindful that a company like NVIDIA would be a great beneficiary of AI. It's just maybe watching for the windows of opportunity to get in. I think we probably would be more preferring the names like Microsoft as an example, which are still expensive relative to the market, but they've been able to successfully carve a number of ways to benefit from AI, whether it's investing in OpenAI or having, like as I mentioned before, offerings or features on their system that can monetize off of the technology.
All right, Amy, always great to talk to you. Amy Kong there over at Corient, helping us count you down to the close. And interesting, Katie, she was just talking about AI. We actually heard from the president a little while ago, basically saying that he's going to try to move a little bit faster here on creating some guardrails for AI. And that actually underpinned the big move that we saw in some of those stocks associated with it.
I'd love to know where that is on the priority list right now, though, for the president. It's a good question.
It is a good question. I don't think he would give us an answer, but we are counting you down to the close. We'll provide you some answers as to what happened today as we take you to the bell and beyond.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Katie Greifeld. We're counting you down to the closing bell. And here to help take us beyond the bell. It's a global simulcast with our friends Carol Massar and Tim Stenovic. Welcome to our audiences across all of our Bloomberg platforms on another volatile day here for equities, commodities, and of course, treasuries alike.
Is it the meta effect? What is going on today?
Meta?
I can't make sense of it. I mean, I'm looking at a meta chart, but it might be true of like almost every equity chart because we've had quite a turnaround from about.
Do you have one of those meta headsets? Those,
no.
What do they call? What do you call them now?
Oculus Quest.
Oculus.
Do you have one?
Sounds like Tim has one.
I've dabbled. I don't have the 3 yet.
Did you see how he like got that so?
I mean, I pay attention
what
to.
What do you do on that, Tim? You just play games?
Yeah, you play games. I've messed around with it a little bit. There's some fun games. I did boxing on that. That was a fun little workout.
You could just you could box in real life.
Oculus Quest.
Yeah.
I think Choppy.
I didn't realize you had that much free time, Tim.
I don't. Okay. No, this was my workout. This was my workout. Yeah. But I do think choppy is a good word to describe today's trade. It's been a while since I've looked at a stat like this, but we moved between gains and losses on the S&P 500 at least a dozen times today. So investors kind of thinking, okay, which way are things going to go?
Did you count that?
Yeah, I just did. I counted it on the Bloomberg terminal.
That sounds painful.
SPX, GIP, and then I used my finger to count.
Did you really do that?
Yeah.
That's cool. That's no, that's high finance. And I was saying to Romaine earlier that it does feel choppy.
That's AI at work, right?
In the stock market, no clear direction there. But then you take a look at the bond market, the message is clear. Yields are higher right now.
Yeah, absolutely so. And that appeared to be the big driver. About half the stocks in the S&P are lower. About half the stocks in the S&P are higher. You put it all together, and the net effect is really a market that is unchanged on the day. Of course, it takes time for these numbers to settle, but right now the S&P 500 right around 4,274, which is right around where it was yesterday at the close. Basically unchanged here on the day. The Dow Jones Industrial Average did move a slightly lower here on the day, down by about 0.2%. The NASDAQ Composite higher on the day by 0.2%, while the Russell 2000 is going to finish the day as the relative outperformer higher on the day by about 17 points.
All right, we're going to get into industry groups in just a moment, but I do want to point energy, really the outperformer. This is oil jumps to a one-year high. Has to do with levels at Cushing dropping to the lowest since July of 2022. Again, the supply-demand dynamics at play. But, you know, Katie, I feel like we continue to talk about energy being really an outperformer.
I'm going to do that right now. You take a look at the industry groups. Energy up about 2.5%. We all know the story. Oil prices in particular through the roof that's benefiting the equities as well. Capital goods also saw a strong day, as too did some of the semis. And of course, we're awaiting Micron results after the bell. You go down the list, there is more red than green. You can see it down at the bottom. Autos not doing too hot today. And utilities, interesting. One of your defensive plays off by about 1.9% today, Carol.
All right, let's.
And I just want to, just before we get to your gainers here, I just want to point out in the energy space, Exxon at a record high, closing at a record high today. And remember, I mean, the last time we had that record high, I think, was back in February of this year here. So quite a round trip.
All right, do we want to mention Micron, guys?
Yeah.
Let's do it. Fourth quarter adjusted operating loss, $1.21 billion. That is just a little bit light. Estimated loss was $1.25 billion. Adjusted loss per share, $1.07. Estimated loss was $1.18. We weren't looking for good numbers from Micron. That certainly was, we were getting kind of some guidance from the company.
Yeah, I mean, certainly so. But I think what more people are interested in is where we are in that sort of memory chip cycle. Obviously, any commentary they might have about artificial intelligence and how their chips, if at all, sort of fit into that, given that NVIDIA has sort of sucked the life out of the room when it comes to the chip space here. I haven't actually had a chance to go through this release here, but it'll be interesting to see whether the guidance that they give going forward is going to be enough for investors to sort of placate them that there is a longer-term growth story here.
Well, Sanjay Mehrotra, Micron Technology President and CEO, in that press release, Romaine, saying, quote, our 2023 performance positions us well as a market recovery takes shape in 24, driven by increasing demand and disciplined supply. Here's your AI shout out. We look forward to record industry total addressable market revenue in 2025 as AI proliferates from the data center to the edge.
Well, but back up here. They're saying industry total addressable. Okay, well, that's good for the industry. I mean, how much of that is going in there?
But they're saying it's going to go from, you know, the data centers, so, you know, those in the cloud and those on premise, as well as to the edge. It's going the whole gamut. It's running the gamut. But you're right. It's not. They're not giving any detailed guidance on that.
And I mean, we'll see what comes of the earnings call, but it seems like after hours traders sharing some of Romaine's skepticism. You see shares down about 2%.
And I just want to interject again here, too, because there are other headlines, too. This is regarding their forecast heading into what is now their fiscal first quarter. They're saying gross margins are going to contract by 2 to 6%. The street was looking for actual growth in those gross margins. So I am curious as to where this is coming from, whether there is maybe a spending story here that investors need to parse, or maybe something else is going on under the hood, Carol.
Yeah, and this is why I said, like earlier, they were predicting this fourth quarter that margins were going to be down. Fourth quarter adjusted gross margin was down 9.1%. The estimate was for 10.2%. We were expecting some of that. But as you say, what they have to say about the first quarter and the outlook, certainly some negativity. And you see the stock kind of kicking around. Right now it's down about 1.8% in the after hours. So we'll continue to parse those numbers and see what other additional commentary we get, certainly from the company. All right, let's go flip side. Let's go to some of the gainers, if we may. Paychecks among them. This was top in the S&P 500 and the NASDAQ 100 throughout the day. This company reporting adjusted earnings per share for the first quarter that did beat the average analyst estimate. Stock is a little changed on the year, but you did see it up about 3.4% in today's trade. DNA, Ginkgo Bioworks Holdings. Talk about a wild trade today. Up about 20% at its highs today. Dropping off of that, but still with a gain of about 2.9% by the close. Did hit a 52-week high intraday. News, the company, healthcare firm, of course, collaborating with Pfizer to develop some new RNA drugs, so some enthusiasm in that one. And Levi Strauss, higher after Cowen started coverage on the company with an outperform rating. They put a $16 price target on it. The stock closing at $13.20 a share. Stock's down about 16% year to date, 10% of the float shorted, but nonetheless, investors liking that call. Tim setting it up about 2%.
And I'm going to add another one to your list. This is for Katie. Ferguson PLC, which we were talking about a little earlier, which we all just learned about here from Heather Brilliant over at Diamond Hill. 52-week high, Katie Greifeld.
No kidding. That's not the Polish grocery store, right? That's
no. This is the HVAC supplier that's actually based overseas in London, but as she told me, they're still a U.S. company. So
valuations, you got to screen for the discounts.
No, we had this great guest on, and she had these stock picks, and they were all foreign companies, and then she said, well, they're not all foreign.
We learned a lot.
Well, that's what's great about this job. You get to learn every single day.
Talk about bringing the discussion to a halt, guys.
All right. Carol did the gainers. I'm going to do some of the decliners. I wanted to point out shares of Meta Platforms. They were all over the place today. This after executives, including Mark Zuckerberg, spoke at the company's Connect Developer Conference. Stock dropped as much as 4%. earlier in the session, ended up moving as high as half a percentage point, fell 0.4% at the end of the day. The company introducing some AI features to its apps. It's going to give the company's users all over the world the ability to chat with people and machines, kind of like what you have with ChatGPT and OpenAI. Some celebrities, including Paris Hilton, Tom Brady, Snoop Dogg in there as well.
Wait, you chat with them directly, or are you chatting with what?
Yeah, they're kind of like avatars of them.
Oh, so,
they're
Tom Brady just gives his voice and they create.
Well, but his voice in his face too.
Okay.
And he becomes like a sports expert.
Now you sold me.
Yeah.
Now you're
He's pretty busy in retirement, I have to say, isn't he?
Well, he's getting his bag. He's like, isn't he like, what is he now? He's like a Delta pilot? Is that something?
Yeah, Delta pilot, I believe. Yeah, no, I think
Okay.
he's a team member at Delta, I think is the proper term.
He's
yeah.
the metaverse, actually.
Okay, so I'm going to continue with the other decliners. NextEra Energy NextEra Energy Inc., I should say, is the worst performer in the S&P 500 on a percentage basis today, down 8.2%. Shares fell after the company struck an agreement to sell its Florida city gas utility to Chesapeake Utilities Corp. Shares also taking a hit after NextEra Energy Partners LP, which owns, operates, and acquires wind and solar, reduced its growth rate expectations for limited partner distributions. The company also cutting its full-year run rate adjusted EBITDA forecast, which hit NextEra Energy Inc. as well. And then taking a look at pot stocks today, Aurora Cannabis down 5%. Pot stocks also all over the place today. I wanted to take a look at them because the Senate Banking, Housing, and Urban Affairs Committee advancing their Safer Banking Act, which would allow banks and credit unions. Well, you're laughing because they've been doing this for years?
Yeah, they've been doing this for years.
Well, wait.
I think what gets passed first? A budget for next year or this bill?
Yeah, that's a good question. I think it's all. It's one thing for the Senate to be able to do this, but this passing the House is an entirely different story.
Yeah, absolutely. I do want to talk about real quickly about yields here because we did see, once again, real meaningful volatility in the Treasury space. The net effect of it was yields higher once again. On the short end of the curve, not by much, just about a basis point here, but the belly of the curve saw most of the action, about 8 basis points higher on the 5-year, 7 on the 10-year here, and even on the long end of the curve, we're higher by 4. And that brings me to a question that I want to pose to you guys here because there's an interesting note out by Bank of America that are kind of looking at the trajectory of yields. We talked so much about what Jamie Dimon had to say in that Times of India interview that 7% wasn't necessarily out of the realm of possibility. They're kind of given a scenario for getting to 5% and staying at 5% and what it would take. But I thought it was interesting. They talked a lot about the term premium and a lot about the fact that some of the moves that we're seeing, particularly on the long end of the curve, to them seem to suggest more, optimism about economic conditions longer term.
Well, that's the question we've been asking for months now. What is actually driving it? Is it economic optimism, maybe that recession getting priced out of the bond market, or are we adjusting to a new regime here, a higher inflation rate, a higher neutral rate? Is that what's going on at the long end of the curve, or have we moved beyond that? Is this technicals? Is this people getting flushed out? I don't know. I'd love to know, though.
Does Carol know?
Carol, help.
I'm ghosting you all right now.
Wow.
No, but it's interesting, our conversation with Peter Atwater, where he was like, what are we missing that's maybe on the negative side of things and more concerns? And, there's so much, it seems like, optimism, even when just the things that come at us, even if you look at the VIX, right? It hasn't spiked up high over some of the worries about a higher rate environment. And even though we've seen rates move up, it seems like there's still a fair amount of optimism out there. So are we missing something? And I don't know. So in other words, I don't know.
That's a great way to end it.
On that note.
We're here with the answers.
I guess I should have just ghosted you guys.
I don't know.
I don't know. Go. It's a new function. All right. I'm going to run. I'm going to hide. That'll do it for our cross-platform radio, TV, YouTube, and Bloomberg Originals. I guess time will tell us kind of how it all plays out. Join us again tomorrow for our cross-platform coverage. We'll see you then.
Stick with us. A lot more coverage coming up here on The Close on Bloomberg Television. A deeper dive into those results that we just got out of Micron. Angelo Zino, Senior Equity Analyst over at CFRA. He'll be stopping by the big program next. This is Bloomberg. Breaking news, Peloton shares higher by 30% here in after hours trading. We're learning that Lululemon has struck a deal with Peloton to use that company's fitness content. So a bit of a lifeline for a company that, of course, has been struggling since the pandemic bloom came off the rose here. Not a whole lot of details. Here's what we know. It is a 5-year strategic deal. It is a global deal, and it will allow Lululemon to use Peloton's fitness content. Now, it's not exactly clear exactly how Lululemon integrates that into its own products and services here, but nevertheless, investors seem that this is going to be a big deal for Peloton, not necessarily for Lululemon. Those shares unchanged in after-hour trading, but Peloton, which has been beaten down big time over the last few months, up 31% here in after-hours trading.
Yeah, Lululemon unchanged, even though in the press release, Lululemon becomes Peloton's primary apparel partner. Hope to bring you more details on that deal as we have them. But let's switch gears now, talk about mortgage demand. It's nearing 30-year lows, of course, as homeowners continue to get hit with high prices, limited home for sales, and tight credit availability from lenders. Let's bring in Erica Adelberg of Bloomberg Intelligence for more on this. And I guess when you add that all together, it makes sense that not seeing much in the way of mortgage demand.
Yeah, no, the problem is not just that mortgage rates are very high, which is discouraging a lot of people from wanting to borrow, but because mortgage rates are so high, anybody who currently took out a mortgage in the past 2 years, which is a huge percentage of the outstanding homeowners, don't want to sell either. Which is only pushing up prices. Existing home prices are now up year over year. Everybody had expected them to plummet, and some of the other indices like the S&P and the FHFA have never even fallen. They're still up there at their new highs.
Yeah, it feels like everyone's waiting for some sort of bubble to burst, both the sellers and the buyers. And it makes sense intuitively, I guess, that you also look at refinancing applications, also not much in the way going on there.
Right. I mean, even the people who took out mortgages most recently in the past year, they're mostly underwater as well. A few Ginnie Mae borrowers may be able to refi at a slightly lower rate because sometimes there are extra fees that are put on when they first take them out. But otherwise, nobody really has any incentive to refinance at all.
I'm curious, have you seen anything like this kind of shutdown? I mean, let's just call it a shutdown effectively here, at least in terms of what the housing market had been like for so many years.
Right.
Have you seen is there any parallel?
Not so much. I mean, I've been in the mortgage market in one manner or another since the late 80s. Mm-hmm. So, that's only, 34 years.
Yeah.
That goes back a long way. The last time we would have seen something kind of like this was the mid-90s, and things were very slow. Mm-hmm. But really, in terms of the affordability issues right now, we're going back to when interest rates were at 15% for borrowers, and that was early 1980s. So that was before I was really paying attention to mortgages.
Yeah, but the market was different there too. I mean, I know a lot of the old timers, they always like to talk about, oh, you young kids with your 3% and 4% mortgages. Look at us when we paid 50% or something just to buy that bungalow down by the shore. But prices, I mean, in aggregate at least, when we look at home prices back then, they weren't nearly, at least on a scale level, where we are in this era.
Yeah, I was actually very curious because most of the, like National Association of Realtors indices and stuff don't go back that far. Mm. So in a recent chart pack, I decided to see just what happened when mortgage rates were at 15%. And yes, actually, as a percentage of income, it was more expensive for a very short time, when interest rates spiked to 15%. Yeah. Even relative to home prices, which were, of course, much lower. That's the only time in history. Okay. Of going back to at least 50 years. So it's been a long time since we've had that. But again, I think the bigger issue as well for a lot of people is just that existing homes aren't moving. Yeah. Mm-hmm. So it just makes it really hard, and that's a really interesting and new phenomena. Where I mean, I don't know if we're at an all-time low in terms of numbers because the number of houses used to be lower in general, but as a percentage of houses, it's very low because of the Fed put its foot on the housing market by lowering rates so far and locking in so many people.
Is this environment good or bad for the mortgage bond traders here? Because I feel on one hand that with everybody staying put, I guess to a certain extent that's good, but at the same time, I don't think there would be a whole lot of new issuance out there either.
New issuance is extremely low. The last time we've seen issuance in this range, like year to date, is 2014. Sorry, I went back a century. 2014. So it's very low, and I think it's hurting.
By the way, you can go back that far. Yesterday, she cited some statistics from 200 years ago, which I should point out no one could verify. So I guess she's right.
But now we're going back about 10 years till issuance was this low, and it's affecting peripheral parts that do help the liquidity of the mortgage market too. Like the CMO issuance is extremely low right now, and that's one of the ways that they bucket together these mortgages to make them attractive to a wider variety of investors. So I think it's challenging, though secondary trading isn't quite as low. So people are still trading around the mortgage market, including when the FDIC liquidated SVB's portfolio, which created some excitement and a little extra liquidity in the sector.
So, I mean, the question everyone's been asking is what unfreezes thing? It feels like everything related to the housing market kind of at a standstill. When you look back at your data, not going back 200 years, but 30 years, the last time mortgage demand was this low, what ultimately got things moving again?
You know, that's a very good question. I mean, ultimately, rates had fallen a little bit since then because rates weren't at, you know, people weren't locked in at 2%. So I think it's going to be, I've looked at charts of, let's say, you know, the mortgage index coupon, which is what is outstanding right now, which is, you know, indicative of what homeowners are owning versus current rates. And, you know, it's been a gradual bull market for 40 years. And so in general, we could count on lower rates to unstick the mortgage in the housing market. And, you know, over any long period of time. And we really can't count on rates getting back below 3%, 2% mortgages anytime soon. So I think it's going to be a long, slow, glacial process. On the other hand, you know, over time, people get used to higher rates and they have to relocate for, you know, housing reasons, family reasons, you know, death, divorce, et cetera. So, you know, I think there's as people get more used to or more comfortable with rates holding in one place, it does probably help unstick things somewhat. But we're not, you know, I think it's going to be a long time before anything near normal.
All right, Erica, really great to chat with you. Appreciate your perspective. That is Erica Adelberg of Bloomberg Intelligence.
Thank you.
Meanwhile, here in Manhattan, a 400,000 square foot space formerly occupied by Neiman Marcus finally has a new tenant. Wells Fargo is planning on buying it for roughly $550 million, converting it into offices. Now, the Hudson Yard area spans 5 floors. It's sat empty since 2020, and we think about commercial real estate, all the woes at the office level. Retailers haven't been doing too hot either.
Yeah, they haven't been doing too hot. And just to be clear, like Wells Fargo, they're not going to reopen the retail store. They're going to use this for just their own business operations, right?
Yeah, that'd be an interesting new line of business for them, though.
It would actually. I think actually some investors might react well to that, given some of the past issues. But but it gets to the point too about how you repurpose some of this space. And we know Hudson Yards was a massive development, and full disclosure, of course, you know, the founder and owner of this company that owns this network, of course, was instrumental in that. But we've seen so many retailers kind of just go by the wayside since then. Of course, the pandemic hit, and then there were other issues there. But you've seen some of that space start to fill back up. New restaurants have opened there. I go by there pretty often.
Oh yeah,
I do. And then because I'm fancy. and then now you have people like Wells Fargo and some of these other companies realizing that they can utilize it as office space.
You know, I could barely tell you where it is on a map. I just stay in
Hudson Yards. It's pretty
Midtown.
big. You can't miss it.
I go Upper East Side, Midtown. You know.
Yeah, you don't go below like what 55th.
It sounds nice though. I want to be where the fancy people
you
are.
and Tom Keene.
Yeah.
Scared of downtown.
No.
Lots happening downtown, by the way.
Apparently.
All right, coming up here, we're gonna talk about the government shutdown and how it would affect the Fed's rate path. That conversation coming up next. This is Bloomberg. As we heard from a couple of our guests today, the prospect of a federal government shutdown here in the U.S. is looking increasingly likely. That deadline this weekend, and it could delay crucial data on jobs and inflation and deal a temporary blow to our gross domestic product. Minneapolis Fed President Neel Kashkari talking a little bit earlier, saying that we might then have to do less with our monetary policy to bring inflation back down to 2% because the government shutdown or the auto strike may slow the economy for us. Interesting. David Wilcox, Director of U.S. Economic Research over at Bloomberg Economics, joining us right now, who wrote a great piece on the Bloomberg terminal, kind of laying out some of the potential consequences of that shutdown, which would start October 1st. And I think Neel Kashkari said the quiet part out loud. I mean, I guess technically he's right. I mean, some of the heavy lifting could be done for the Fed should that shutdown occur.
You're right, Romaine. There's never a good time for a government shutdown from the Fed's point of view. This is a particularly awkward and delicate time. The Fed's trying to pull something off that's really difficult, and that is to bring about that fabled and rarely observed soft landing. A shutdown's going to add turbulence to the economic environment and may obscure the Fed's ability to have clear vision of what's going on in the economy.
We've had these shutdowns before, and I actually lived through one way back in the 90s, David. We're talking about several 100,000 federal workers who, in theory, would be furloughed should they not reach an agreement this weekend. But there's also a broader ecosystem of folks who don't necessarily work for the federal government, but would effectively, potentially, either lose revenue from their businesses or maybe even be out of a job themselves.
That's right. The shutdown, for as far as federal workers are concerned, the shutdown will be self-healing. Congress actually passed a law in 2019 that cleared up any uncertainty about whether federal employees will be paid retroactively for the time when they were prevented from being on the job. Contractors don't have that certainty. Contractors actually know that they're not going to be paid, and so there's going to be a world of hurt in that environment.
Let's talk about what this also could potentially mean for the economic data calendar, because let's see, we have the jobs report, we have CPI, retail sales, and PCE all scheduled in October, of course. If those publication dates are delayed, what does that mean for the Fed as they try to make policy?
It probably doesn't have big immediate implications. Their next meeting isn't until the end of the month. So if the shutdown is relatively brief and the employment report, for example, currently scheduled for publication on October 6th, which is a week from Friday, that won't have severe operational implications for the Federal Reserve. The longer the shutdown goes, the more threatening the implications become, partly because of that deprivation of information, but also because the collection of the microdata for the October statistics will be damaged, and that's not reparable.
And David, just in the last 30 seconds or so we have with you, in your report, you also highlight the data quality element. If we do get a shutdown, what could that mean for the quality of the data that we eventually get?
Nothing good, I can tell you that. Under normal schedules, the Department of Labor would be in the field starting October 15th, asking households what their employment status was during the prior week. And that's the exercise that gives rise to the unemployment rate and a raft of other absolutely critical metrics of what's going on in the labor market. It's a different matter if the Labor Department has to ask the household, what was your status 3 weeks ago? There's a ton of social science research that shows that recall bias is really serious and damaging.
All right, David Wilcox down at Bloomberg Economics, a great read on the Bloomberg terminal, laying out some of the scenarios should that shutdown occur and how it would affect the Fed and the economy. This is Bloomberg. Another volatile day for markets here in the U.S. and abroad as well. The net effect of it, though, was, well, equities relatively unchanged on the day. There was a little bit of strength in the small cap space with the Russell 2000 ended the day higher by about 1%. But there were also some big moves higher when it came to the dollar. Now on a 6-day run, longest win streak for the Bloomberg Dollar Spot Index all year long. And Treasury yields continue to shift higher, still camped out at those multi-year highs. Meanwhile, you take a look at WTI crude, 93.67 in the new session here as we move forward into the next day. A 4% rise here earlier today in the main session, but more importantly, a march back to not only year-to-date highs, but 52-week highs and $100 a barrel now in play. That's the macro backdrop for a market that's still trying to make sense of fundamental valuations. Valuations right now, Katie, that have been getting a lot harder to make.
Let's get to some breaking news just out about Uber. The ride-hailing service is naming a semiconductor executive, longtime finance leader, as its new chief financial officer. For more, let's bring in co-host of Bloomberg Technology, Ed Ludlow. And Ed, what do we know about Uber's new CFO?
Yeah, so this is Prashant Mahendra-Raja, who's coming from Analog Devices. You know, he is a numbers guy, spent a lot of time recently in the semiconductor space, but also had tenure at other technology companies. He led global planning at Visa. I think there's some sort of muted after-hours reaction on Uber shares, right? I think they were up at one point, half a percentage point. But it's an important time for Uber. They've only just registered operating profit for the first time in the second quarter just gone. And this is a guy that did see EPS growth throughout his time at Analog. He has M&A experience. And people at Uber are excited for him to join.
Is there any sense here as to why this transition now? I mean, what was the reason for Chai moving aside and bringing in Mahendra Raja?
Yeah, look, Chai had 5 very busy years at Uber, including the 2019 IPO. The street constantly hit him on when profit was going to come, and not just on an adjusted EBITDA basis. They have entered this phase of profit and growth, and by all accounts, Nelson Chai wants to now move on to something else. That has been the real messaging focus from Uber, that they want to be consistently profitable, and that based on track record, Mahendra Raja is the right guy to do that, Romaine.
All right. Of course, the new CFO, that is the big headline here. Mahendra Raja going to be taking over as CFO over at Uber starting in November. We want to move to another big story of the day, and that's the earnings that we just got out of Micron. Those shares have been oscillating in after hours trading, now down about 4%. A big miss on several key metrics, and their guidance going forward really seems to focus in a big part on CapEx spending and where that spending goes. Angelo Zino joining us right now, senior equity analyst at CFRA. He's got a buy on Micron and his $77 price target. Let's start off with some of the spending levels here, because it does look like that they're, in their words, they're planning to spend less on CapEx heading into this fiscal 2024 year.
Yeah, I mean, listen, as far as kind of our view in terms of, how the CapEx plans are going to work for Micron, it's pretty much going to go with the trajectory of their business, right? I mean, we kind of look at Micron 2023 is kind of like a bottoming out year in many respects, after a significant decline in the second half of 2022 into early 2023. And when you kind of look at 2024, you kind of start seeing the recovery here starting now. You continue to have losses and what have you, but we see positive free cash flow and profitability by the time you hit the second half of calendar 24. And then 2025 is that expansionary year, or that's the hope when we kind of get to that point. So I think the CapEx plans kind of go in line with that type of sentiment out there. It's not anything you should necessarily expect kind of in terms of Micron just getting out of hand in terms of CapEx plans, but there is a trajectory for them to start, increasingly spend a little bit more as the business recovers.
Give us a sense here. There was also a lot of commentary about inventory levels, both for Micron itself, but more importantly, its customers. And it seemed to use the word over and over again of normal, that things have normalized.
Yeah, I mean, listen, I think also when you kind of look at the forecast on the revenue side of things, right? I mean, they essentially kind of beat extremely low expectations for the August quarter in terms of the guidance. They did guide a little bit above our expectations for that November quarter. And a lot of it is actually coming on the NAND side of things. But when you kind of look specifically on the PC side of things, on the smartphone side of things, a lot of these consumer-driven markets, which really kind of hit Micron hard here over the last 5 quarters or so. They did point to the fact that inventories are starting to normalize there. And you kind of look at, what a lot of their competitors are doing in terms of the Samsungs and the SK Hynixes of the world. They've kind of, especially Samsung in recent months, have, finally gotten to the point where they've significantly cut their kind of CapEx plans and production levels. So that's kind of helped kind of normalize the channel out there a bit. So we are definitely kind of exiting calendar 2023, we think, in a much better position in terms of inventories out there, especially on the customer side of things. In terms of internal inventories at about 170 days, I think definitely above where they essentially want to be internally, I think is about 120 days. Some of that is going to be strategic in nature as we kind of, go towards a more AI-driven environment. They did point towards fiscal 24 on the DRAM side of things being stronger than we anticipated. So I think that some of that is going to be strategic in nature.
Yeah, Angelo, if you look at the forecast, it seems to suggest that sales are going to start to grow again in the fiscal first quarter. Is that realistic or maybe a little optimistic?
Listen, I mean, this is a company that's seen its revenue decline north of 50% peak to trough, right? I mean, this is probably the ugliest downturn we've seen on the memory side of things since the financial crisis. So it's been a long time coming here over the last couple of quarters for us to finally see an upward trajectory on the revenue side of things. We've kind of been bouncing along kind of the bottom here for the last couple of quarters. I do think there is kind of a real aspect to this recovery here in the November quarter. I do think more of the surprises on the NAND side of things. Calendar 2024 is, I think, where the momentum builds in terms of high bandwidth memory, in terms of the kind of greater AI capabilities or memory inside the data center. I mean, these kind of AI workloads are supposed to have 8x the type of 8x the DRAM memory than you see in traditional workloads. So they are ramping up kind of their next-gen high bandwidth memory in calendar 24. We think you see that momentum next year, and that'll further support kind of the recovery on the revenue side.
I'm also curious to get your thoughts on some of the geopolitical overhangs on Micron. Of course, Beijing has designated Micron's products as a security risk. When you think about sort of the reliance on China for its revenues, how are you thinking about geopolitical risks as it relates to this stock?
Yeah, I mean, absolutely a risk for Micron and the broader semiconductor industry. When you kind of look at how Micron is exposed, about a quarter of their revenue, they've kind of highlighted about 12 to 13% of their revenue at risk. The fact that you didn't see any sort of downward revisions heading into this earnings announcement, I think was definitely a positive sign. And I think also the guidance in terms of the November quarter also kind of a positive sign in terms of kind of where the demand environment is on China's side of things. I think kind of some of the prior commentary that they did give in terms of China was more of kind of a worst case scenario type of thing. So when we kind of look at it looking ahead, we think kind of the upside to the recovery on the pricing side of things, on the demand side of things, will more than outweigh potential kind of hiccups along the way on the China story.
All right, Angelo, always great to catch up with you. Angelo Zino there. A closer look here at Micron earnings here. Once again, shares lower in after hours trading here, still waiting in that conference call, just getting underway right now and getting some commentary out of the executives right now here about the future, not only of the memory chip cycle, but more importantly here, the longer term ambitions and how they integrate AI. Coming up here, we're going to continue our focus on the chip sector with a closer look at the tensions between the U.S. and China over those advanced semiconductor technology. Sara, clinical associate professor of supply chain management at the University of Tennessee at Knoxville, going to be joining us in just a second. This is Bloomberg.
All right, well, let's get to the latest on the tensions between the U.S. and China over advanced semiconductor technology. And joining us from Washington to explain where things stand is Bloomberg's Enda Curran. And Enda, it feels like the chip sector is still very much sort of the arena where a lot of these tensions are playing out.
It really is. It's the front line of the China-U.S. geoeconomic story. In recent weeks, we continue to see the U.S. push through with export controls on technology to China. We see them pushing through with details around making sure that companies in the U.S. who avail of subsidies from the U.S. government to boost chip plants here don't also expand their businesses in China. And on the flip side, of course, we saw Huawei come out with that smartphone recently, stoking the analysis that it shows that China can actually advance in the semiconductor field despite the U.S. controls. But of course, the U.S. Commerce Department pushed back on that. But regardless, the point is that the U.S. is trying to clearly stabilize relations with China. They talk about, for example, it's about de-risking rather than decoupling. But when it comes to that de-risking, semiconductors are front and center in that because of their potential for dual use, because of their role in so many critical and sensitive technologies. The US and China are saying they can maybe trade in some areas, but clearly the US is drawing red lines around the chip sector. And that's why, as you mentioned, it continues to be front and center in what's happening in this tension between both massive economies.
Well, to that point that there's been efforts to stabilize the relationship, of course, we've seen a lot of high-profile visits of Biden administration officials to Beijing over the past couple of months. Is there anything in the offing, any plans, any meetings that would suggest that maybe things, specifically when it comes to semiconductors, might get a little less tense?
Well, there's no doubt, you're absolutely right, Kate, that there has been certainly a conga line of US officials going to Beijing. We had, of course, that meeting between Jake Sullivan and Wang Yi in Malta in recent weeks. The big one, obviously, to look out for is what happens at the APEC Trade Summit in San Francisco in November, and whether or not President Xi Jinping does come to that, and if he does, whether or not he meets with President Biden. That would obviously be a very important meeting, the first time sit down, I think, in a year or so since the Bali summit. But whether or not there's specific progress made on semiconductors, I think that's probably unlikely, given how it's been identified that that's one area that's clearly a red line for the US. I mean, obviously, when you listen to speeches by Janet Yellen and others, there's areas where they say they can cooperate, areas where they can do trade without any kind of concerns over national security. Obviously, they talk about wanting to work together on climate change, for example. But I'm really not seeing much ground for easing up tensions over those dual-use technologies, and semiconductors are at the front line of that. So keep an eye out for whether the meeting goes ahead, but less, I think, lower expectations for any kind of a breakthrough on specific technology measures.
And just curious, too, I mean, I know we're talking about what's coming out of the White House, but is Washington overall, meaning the politicians here, whether they're Democrats or Republicans, are they largely in line with the Biden administration on this policy, on this stance?
Well, look, there seems to be a bipartisan consensus when it does come to certain policies around China and the risk of dual-use technologies and clamping down on sort of sensitive technologies does seem to have bipartisan support. China obviously rejects that, I should say. Romaine, they say that the US is trying to contain their own economic development. They're trying to maintain US dominance over the global economy. They obviously emphatically disagree with what the US is trying to do. But I think when it comes to domestic politics and when it comes to the China story, there does seem to be consensus around curbing China's development in key areas, and obviously high-tech and technology, quantum, AI, those kind of areas. That's front and center in all of this, and semiconductors are very much in the middle of all of that.
All right, great to catch up with you. And Curtin there, a nice wrap up here. We want to continue this conversation right now about what's going on in the chip space with Sara, who Clinical Associate Professor of Supply Chain Management at the University of Tennessee at Knoxville. And Sara, great to catch up with you again. And I actually want to start off with the news that we just got out, which was Micron's earnings here. But they specifically addressed this China issue, basically talking about how it remains a headwind. And I was just going through some of the numbers here, at least based on what they've reported publicly, and the percentage of revenue that they're getting from China now, and the huge drop that has already occurred, even though most of these restrictions were just announced earlier this year.
Yeah, I think that it was really a shock to Micron. I did catch up with a couple of executives at Micron recently, and even though it was in their earnings report of annual report in 2022 listing China and potential banning of their sales of their technology in China as a significant headwind, still they felt really blindsided by the moves that China's Cyberspace Administration took earlier this year. And so, they're really trying to recover from it. The good news is, as, has been reported previously, is that, there's enormous upside in the sector. And Micron is in the process of developing new technologies to support artificial intelligence.
I'm curious as to how long does that sort of process take? I mean, I feel like these are the types of technologies, you're not just flipping a switch and all of a sudden saying, hey, voila, we're ready to go.
Right. It takes several years and, quite a lot of testing to get it right. And their most recent development has been a high performance memory solution that can enhance AI data centers. And that's really going to assist higher technologies in, processing large amounts of data.
And Sara, I mean, something I always think about, even though maybe Micron is able to manage past some of the tensions coming from Beijing, I mean, what's the end game here? Because it's not just necessarily Beijing trying to limit U.S. companies. The U.S. is also limiting exports of its AI-capable chips. I mean, what's the end game here?
Yeah, so the end game is getting to AI capabilities first and best. There are many security concerns associated with artificial intelligence, and that's really at the heart of all of this. In fact, we saw Secretary of Commerce Gina Raimondo talking about the limitation of some semiconductor sales to China, and she was talking about the fact that it's not these sort of lower level chips that she's concerned about, but the ones that can really be used in higher level AI algorithms that could be potentially used for military uses or for other types of things that, may come down the line, which would majorly disrupt society.
And as part of China's efforts to get there first and be the best, as you say, of course, they're trying to raise that state-backed semiconductor industry fund. The Financial Times reporting that they're struggling to raise its target of about 300 billion yuan. That's about $41 billion. Is that the way that this is going to play out, that you have different countries trying to really put their muscle behind it?
Well, that's what it's seeming like these days. We saw the U.S. CHIPS Act passed. We've seen, as you mentioned, China's fund passed. That has already experienced issues with its administration in terms of experiencing some corruption allegations. And we've seen the European CHIPS Act also passed. And so a lot of stuff is happening in this sector. It's really a race, and it's a race for artificial intelligence gaining in that area.
Well, it's a fascinating race to watch. Really appreciate your time and your insight. Our thanks to Sara Su. She is Clinical Associate Professor of Supply Chain Management at the University of Tennessee at Knoxville. Now some breaking news, Romaine. Elon Musk's SpaceX has received its first contract from the U.S. Space Force. Now, it would be to provide customized satellite communications for the military. That is under the company's new Starshield program. And of course, this decision extends Musk's role as a defense contractor, potentially right before the government shutdown.
Right before the government shutdown. Yeah, hopefully this is a longer term deal, and they're playing the long game here rather than just dealing with the clown college down at in the domed Capitol there. But look, this gets to the point too. And let's face it. This is basically a taxi service for all the space junk we send up here. And the problem is that there aren't a lot of other competitors. There are. No disrespect to some of the other competitors, but there is a specialization that SpaceX has shown that some of the other ones have yet to show.
Yeah, it's competing with 15 companies for about $900 million in work orders. This is through 2028. So yes, through next week under the Space Force's new proliferated low Earth orbit contracts.
Yeah.
I have to confess, I haven't really thought much about the Space Force in a while.
About Space Force?
Yeah.
Well, funny, I shouldn't make fun of it, but, by the way, I was the host of the Boston Pops Fireworks Spectacular.
I remember that.
And this was the first year, they have this great moment where they play the anthems of all the major military forces. So Coast Guard, Marines, Army, Navy.
What is the Space Force?
And Air Force. And this was the first year that they had an anthem for the Space Force. And it was actually pretty good.
Really?
Don't ask me to repeat the lyrics because I can't remember them. But yeah, it's a new era, and hopefully we don't have to use the Space Force for anything other than just
That's true.
basic things. But who knows? It's a big world out there, and I've seen a lot of sci-fi movies, so I assume at some point we're going to be out there somewhere. All right, stick with us. We're going to set you up for what to watch tomorrow. This is Bloomberg. All right, a lot of catalysts battling this market around here on this Wednesday afternoon. A push ahead to Thursday, where we're going to be on watch for any progress to avoid that government shutdown.
And you can see this is an all-day event, that U.S. government shutdown watch. That Saturday deadline quickly approaching.
Of course, one of the big consequences of a shutdown is we don't get any economic data, so enjoy it while we still have it. Pending home sales coming out tomorrow.
Pending home sales, GDP claims as well. And also, we get some manufacturing data as well.
All right, you sound very excited about that manufacturing data.
I'm thrilled.
Hey, or maybe this will excite you.
Yeah.
Richmond Fed President Tom Barkin, he's going to sit down with our very own Michael McKee tomorrow at 3:30 p.m. Eastern Time.
Yeah, I am excited for that one, of course. It's a very critical juncture for the Fed. And now that we're talking about a U.S. government shutdown, of course, that conversation becomes a little bit more urgent, what it could mean for the Fed and their policy making.
Yeah, 3:30 New York time, 8:30 if you're in London, and if you're in Hong Kong at 3:30 a.m., you can wake up and watch that as well. Meanwhile, earnings after the bell. Nike tomorrow.
Nike, yeah, that's an interesting read.
Yeah, you're a runner, right? They sell running shoes.
Big time, yeah. And of course, that's an interesting read on the U.S. consumer, but also their China business, obviously